Okay, Danny, you ready? Call the meeting to order. Again, our notice of video recording, which is your tape.
Not only your voice, but your face. Dan, would you call the roll?
Mark Notick,
Here.
Carl England,
Here.
Jack Prothero,
Here.
Terry Cohy, John Satry,
Here.
Diane Fladmo, Maggie Peterson, Jeff Greenfield,
Here.
Senator Sales,
Here.
Representative Hamilton.
Here.
Okay, now it's time on our agenda for public comment on anything within the board's jurisdiction, but not on the agenda. Do we have it today?
Mr. Chairman, I don't think we should let this pass without acknowledging that this is the last board meeting we have with David as an employee of ours and our executive director. We honored him last night at John and Paulette's home, and thank you again for your hospitality, but that's sort of off the record, and so I think on the record, I just want to make sure we mark this milestone and acknowledge the fact that when David acknowledged the fact that, first of all, a long career of public service, period, including the work for the board and being in the legislature and budget director and then our executive director, and also acknowledge the fact that when David became our executive director, we were in good shape, and what David did was make the place better, and that's not easy to do. And there are a lot of ways in which he did that. I don't want to make a list and forget something, but I think it's the things that stick out in my mind is that I think David increased the transparency of what we've done here in keeping with our constitutional requirement of open government. And then the thing that sticks out in my mind is the way he further empowered our talented staff to do their work and to make us more aware of who you all are and what you do and how you do it and how impressive it is that you are. And those are things that I hope to help change the culture here for forever. And I just want to acknowledge, and I think I do so on behalf of the board, that it's been an honor and a pleasure to serve with you, David, and we wish you nothing but the best of luck in your well-deserved retirement.
Well, I handle that, and I'm not going to try to follow up. So the next item on our agenda is public market investment.
Morning, everyone. The Public Markets Group had a termination in July, early July, and it was Voya Investment Management. And so given the protocol here, we thought we'd describe this to the board and the transition as well. It's a very board meeting. This is it. Voya was with us for a little over 5 years, and they were a domestic small cap growth manager. They had a lot of changes in their investment staff. They had a change in their portfolio manager a little over 2 years ago, and also had quite a bit of turnover in their analyst staff. We felt that because of that, they're in this transition period of having this fairly new portfolio manager who wants to add to his investment staff. So he feels he's understaffed at this point. He is not as comfortable with working as a star portfolio manager as the previous manager was, who did a lot of work on his own. So we just felt that, given that the investment staff at that place is in transition at this point, that it really probably isn't worth our while to be invested with them while they kind of put things back together, so to speak. So with that reason, we decided to terminate Voya, and for the time being, we moved the money into the small cap ETF. But this is one of the cases where our due diligence that we do forward due diligence on Steve Strong in particular in the small cap growth area, we have a bench of managers that we can also look to, our 2 or 3 of our managers that have come out of his due diligence work that we're interested in as well at this point. But for the time being, we're going to put the money into an ETF.
So Randy, how is Voya's performance over that time?
They like the benchmark a bit. That really wasn't as nearly as big a concern as the staff turnover, though, because they were more of a defensive growth manager, and it really wasn't their market the last 4 or 5 years in the bull market. We expected them to like it. The turnover was the primary reason. So with that, Mike will describe the transition that took place.
Sure. Chairman, members of the board, following the decision to terminate Voya, we consulted with a couple transition managers to evaluate the best way to transition the assets that were managed by Voya. We actually considered multiple options. As Randy mentioned, as IWM, the iShares Russell 2000 ETF is a current investment in the portfolio. So we looked at different options and got opinions from these transition managers, and that turned out to be the best option. So the main goal of the transition was to maintain market exposure from the time that we started with the legacy assets to the target portfolio. And we were actually really pleased with the results of the transition. State Street's Global Markets, their estimate on the transition was about half of the other transition manager for the same exact plan. And we liked their plan in terms of maintaining the market exposure. So they actually sold about 85% of the portfolio over the first day at market on close, which significantly reduced some of the market impact and other things that we might see from that perspective. We traded 15% of the portfolio the next day in the open market. So by doing only 15% kind of during the open market the next day, it cut down on some of those expenses that we might normally see. In addition to that, State Street actually beat their estimate. So they were half of another estimate we had at 8.3% for the, or 8.13 basis points for the transition, and they actually came in at 7. So if you turn to the total assets involved here, it's about 78 million and 140 million. So if you turn to the third page of the handout, which basically says page 3 of 9, kind of outlines some of the cost here in the left-hand column. Cost of commissions, $22,000, 2.9 basis points. That was at 1 penny per share. We have other components of the transition here: bid-ask spread, market impact. Taxes and fees came in, at 1.3, and then opportunity cost, which is basically representing the volatility of the prices of the securities. They started trading Friday market on close, finished the rest on Monday morning throughout the day. And, we've never really looked at it at this level of detail, but we actually asked State Street, well, tell us how many purchases you made. How do you line up the sales of those securities? And it was actually pretty impressive. They sent us a list, and they were buying IWM as each sale occurred. There was, I think, 173 purchases of IWM. So that's how closely they were trying to match the sales with buys and maintain market exposure.
Why didn't they view it all in aftermarket? Why did they, or is some of them too small?
Well, they want to minimize market impact. So basically what they do is they look at a percentage of the trading, the average trading for the day, the trading volume. If they exceed some of those benchmarks that they set up and averages, then that tends to actually move the price of the securities.
Oh, so they've done the whole
Yeah.
thing. Got
So
it.
they looked at the whole list of assets, all 140 names. They looked at the average trading volume of those, and they said, okay, this is kind of our bogey in terms of how much we want to trade of that. And so that's where the 85% came in, and that was pretty close to what they thought their estimate would be initially. And then that other 15% they traded throughout the course of Monday open trading. So with that, any questions?
So, did I understand this right, when you were started shopping for manager or transition managers, you were quoted a price basically 16 basis points?
Oh, close, it was 15 basis points from one, for the same exact.
Right, and you went with the one that said 8,
That's correct.
and they did it for 7.
That's correct.
Well, that's good.
Yeah.
That's a nice trend, right? I got this right?
Yeah, it was a good story. Now, that being said, that doesn't mean that, you know, we could have gone the other direction based on, you know, things that happened in the market. But, you know, when things work out in our favor this way, we're always pretty good.
My other question is to Randy. Now, so we had all these personnel changes in Boyd, right? That was the reason. Now, do they notify you of those, or do you know about those because of the diligent quarterly?
Exactly, yeah, we know about those changes given that when we do them quarterly. But even before then, if they have changes, a lot of times the managers will let us know before that quarterly review. But like you're saying, over time of our knowing the manager and monitoring them on a consistent basis, that we know they've had this turnover and they've been trying to rebuild their analyst staff, so to speak.
So this example where those quarterly meetings.
Yeah, I would say this is a good example of why those pay off.
Thank you.
Brandon, market impact and opportunity costs. I can understand how you could get an accurate commissions and bid-ask spread. But how accurate in your estimation or opinion that market impact, how can you really judge that? And what is it, what does it mean by opportunity costs and how do you measure that?
Well, market impact, David, it's the effect of trading, you know, the effect trading has on the market price of the security. So what
They
will
can measure that, they can see that, they get a sense of
They
it
can see the volatility of that. And
by their own actions?
yes, and you know, I think what they do is they benchmark the price of the security based on when they start trading. So they take a look at the pricing of the security when trading and when the transition when the transition occurs. And then as they're selling the portfolio, as they're selling those positions, they can see the movement of the price relative to the market.
Did they attribute that to themselves?
Well, I think it could be attributed to themselves in terms of executing those sales, but if they might assume that the volume of the security is X for, you know, the transition, and that's how they determine we're going to trade 85% here and 15% here. On a given particular day, they might find that the volume is not there, so they can see some of the price movements on the security that actually occur. So that's one of the explicit transaction costs that the transition managers report on this particular line. The one that's a little more, I don't want to say the word fuzzy, but it's a little bit different, and that's the volatility over time, over the course of the entire transition. And that's opportunity cost. So opportunity cost is defined as the total cost of the transition minus these components that they actually measure. And that captures any residual difference that happened between the actual cost of the transition and things that are more explicit like commissions, bid-ask spread, taxes and fees. So that's how it's defined to us.
Bit of an aside, but I think it's worth just illuminating. I remember when Randy was trading securities and he could see in real time. And it seemed like the market knew, they could sniff out when you're looking for, you know, we're looking at the GIP and like buying or selling, and you were a buyer, and you wouldn't think our volume, the market could sniff out. We're not that big, but apparently we were big enough that you could see that. Any comments about that?
Yeah, you have to, and this is what transition managers do, among other things, but you have to be aware of, you know, what the trading volume is in a particular stock that day, and therefore what the size of the trades are that you put through. Because if you put too big of trades through, you know, you can move that price because you got all these, you know, algorithms and such out there that will pick that up.
They will know, even with our, you know, we were big, but we weren't huge. They could tell. I mean, you know, he would dribble it out, and you can see, they know we're buyers, that you could see the bids would either go, you know, would be going against us. You could see it in real time.
Yeah, and it wasn't as much of a problem with like a stock like Microsoft that trades, you know, a lot of shares, but the less liquid the stock, the more cagey you have to be as far as, you know, what you put out there to buy or sell.
Thank you.
Mike, you're saying there was 140 names that Voya held, and in those positions, what would be the average size relative to what traded in the market?
That number I don't have. I can find that number for you, but generally, I don't know if you have any ideas in terms of the size of that.
What was your question?
The 140 positions that were held by Voya, the size of those positions relative to their either float or average market trade.
Yeah, I don't know what the exact data on that is, but any small caps in that area are going to be less liquid, of course, than the large caps, and so typically you don't want to be more than, say, 5% of average daily volume. And that's one of the things that the transition manager looked at as far as how much to trade on market close. Is they didn't want to have the trades for the various 140 shares from the Voya account. They didn't want to have those be too much of the trading volume on the market close, because that would move the price against us.
Yeah, the actual numbers that State Street Global Markets gave us is they typically target 2 to 3% of the average daily price in terms of the trading, so they don't want to exceed 2 to 3%.
Yeah.
Does that answer your question? Thank you.
Joe?
Certainly we're number 11, investments.
New Redmond's investment commitments. Michael Terry.
Members of the board.
Before you get started, I have a question. It says on the top of these confidential, or at least on the first one. Define that for us so we don't do something we do, or because it's on the record here.
Mr. Chairman, if I may, in general, in Montana state government, information is public. There aren't many exceptions. There are some exceptions. The one that I think gets the most publicity is the right to privacy. But there are a few others in statute. Montana does have a trade secret statute. We do sign non-disclosure agreements. The private equity is a space where intellectual property is closely guarded, and one of the intellectual property is the strategy and the details, many of the details that are in these write-ups. And so that you have them, but these details are proprietary. And so that's why we are now putting on these, because we share these with you as board members, but we don't share this information with the general public. And so, because this is you know, this is the essence of why these particular people, they're being open to you as a potential partner of their competitive advantage. And they don't want to share their competitive advantage with just anybody. It wasn't that good.
Thank you, David.
Well, it just raises in my mind that to the extent to which we might want to be referring to the details of this in our discussion, because we are on the public record. It's never been an issue before, but I never was aware that it was. Give that a lot of thought.
You know, I think at some point, we've got to be able to have something in front of you. To me, this is a satisfactory compromise. You've got the details, you can ask the questions on air. We've been comfortable, but Mr. Attorney Chairman, have I run it by council? I have not run it by council, I will tell you that, no, I have not.
Don't do that, because you may not get what you want to hear.
No, I think, you know, you're the client, I think you've got to be able to see the details, you know, but I think we need to be circumspect about, in toto, we don't want, in fairness to the, but the pieces, I don't think that they can connect all the dots with the pieces. And so I think.
It's not exactly truly detailed.
Right.
I would say in general, historically, it's been fine. Please feel free to ask any questions. If there's anything around trade secrets or a competitive advantage that the manager might not want to share publicly, we would probably refrain from answering in detail and follow up with that aside.
So I'm Terry Kolnick, one of the private investments team analysts, and I'd like to talk about Fidelity Real Estate High Income Fund. This investment is significant because it's our first private investment in a fund that invests in publicly traded real estate securities. We invested $20 million into Fidelity on July 16th. This is a diversified mutual fund that invests primarily in high-yielding CMBS securities. One thing that drew us to this particular fund was that the strategy involves deep credit research and analysis, as well as on-site due diligence on the underlying real estate. They in order to accurately underwrite the real estate, they visit on-site as many team members as necessary and as often as necessary. And most of the team members have backgrounds in real estate. Are there any questions on this?
Would this be considered like a fund-to-fund type of entity?
No, it's a mutual fund, and it actually has fairly low fees at 0.8%, so not something we'd see in a fund.
It has its own what?
It has fairly low fees at 0.8%, and that is particularly, it is particularly low because Fidelity, as the wider organization, provides all of the back office accounting and compliance and IT that this team needs, so that the 7-member team, all they do is invest this fund. They don't have to do all those other things. So we actually visited them, Ethan and I, and it was very impressive, the level of compliance and internet and trading capabilities that they have. Thank you.
Good morning. I'm Emily Kovar, investment analyst on the privates team as well. And first, I'd like to talk to you about our recent investment in AG Realty Value Fund 10. On August 2nd this month, the staff committed $30 million to Fund 10. Angela Gordon and Company is a firm that we've been investing with over 6 funds since 2009, and we have invested with them $135 million to date. The business has been they've been investing in real estate for over 25 years. They have 19 real estate funds over that time frame, and they've deployed $11 billion in equity into the real estate market. This has been a valued partner of ours over the years. They have proven themselves to be very adept at navigating and investing through all the cycles of real estate, and their returns especially have been quite impressive and top quartile as they invested through the last downturn in GFC. We committed $30 million to this fund. This next fund is really doing a non-core real estate focus, so they will be looking at value-added properties as well as some opportunistic properties within the same fund. And with that, I'll open it up to any questions you may have.
So 20% is non-US, up to 20%?
Actually, they do have I'm sorry that this wasn't updated. There's the primary fund can do a 20% non-US sleeve. We actually, they offered a different vehicle within the fund where you could invest in US only, and that is what we signed up for. So for our commitment, we are going to be in US only.
Why?
Why? We discussed as a team, we've previously invested with AG and they have had the international exposure. We are very, very confident and comfortable with the US-based team, and we've met with them, we did due diligence on site with them. And we decided that as we have moved forward in our portfolio, we're being very critical and really diving in and getting to know those teams and understanding those investment strategies. We decided that because we had not had the opportunity to meet the international team and get to know them as well, that we wanted to withhold and not invest into the international side of the fund because we just hadn't had a chance to do that due diligence and meet with teams from Asia and such. And so we decided to stay with the US only sleeve. Plus the returns in the US only sleeve, if we look historically over their track record, their US investments have had higher returns than some of the international properties in the fund, and we felt strongly to have that exposure be the focus of our next investment.
I would add that there are separate vehicles for Asia and Europe, and so we could look at those at a later date and make our own strategic allocation if we wanted, whether it's 20% or 50%. So it's not like we are missing that opportunity by passing that.
Do you feel that you're in a good position to evaluate international managers?
I believe that we are, and that's one of the efforts that has been made within the budget, that we need to travel and see those managers and judge the teams on site, see their offices, look at their systems in real time. I believe that we do have that capability and those opportunities to do so now. And we will be opportunistically looking at funds outside of the United States, specific with managers as we move forward. Any other questions on Angela Gordon?
Who was Angela?
John Angelo was one of the founders of the fund, and he built a very strong firm. He's since passed, but they've got a great team behind him. Next, I'd like to talk to you about our recent commitment to Axiom Asia Fund 5. Axiom is a fund of funds manager. They have a primarily lower middle market buyout focus, but also looking at growth capital and venture capital funds in the Asia space. We have been investing with Axiom Asia over 3 funds. We've deployed $90 million to them. And their returns have been top quartile for their strategy and in our research as we did the underwriting for this. They've proven to be a very good partner with us. To address your question earlier, Carl, oftentimes if we have questions about a specific manager that's outside the U.S., we're often able to just do a quick call to Axiom, and because of the vastness of their underwriting capabilities and their knowledge of the space, they're able to give us great opinions on managers outside of the U.S., and we lean on them a lot for those aspects that they can bring to the relationship. So with this, we did commit $40 million to Fund 5, and they've got a deep pipeline already, and they will be deploying those assets across 20 to 25 private equity funds over the coming years.
So this is kind of the exception. It goes back to sort of Carl's question as far as our ability to do diligence. We may expect to grow in the future, but and we're not inclined to do fund-to-funds, but we do target our spot. Michael, any sense of your vision as far as the future, as far as is this a space you think for the long term, or you think that the team will grow so that we independently? Do you have any goals as far as international equity and quick thoughts about it?
Yeah, I think for the current time, Axiom has been a very good relationship, accretive to the portfolio. You're paying another layer of fees, but what are you getting off of that? And their returns have been excellent. So I think at this time, it's still beneficial and appropriate for the portfolio. As far as building out our direct program, I think we'll see more and more direct names come out. It'll be in Asia, later in the quarter, Emily will as well. We will start to build out and really focus on direct relationships. What kind of time frame will that be? A short or intermediate term? I don't know. I think we'll be methodical. Slowly, I would imagine we'll phase out our fund relationships.
Any other questions? Thank you.
Morning, everyone. I'm Michael Way, investment officer, for those of you who don't know me. To that point, we made an investment into Crescent Asia, focused on consumer growth and special situations in Asia. This is a direct investment. This is part of our effort to build out a direct program. One of the questions you might ask is this in Axiom? It's not. The question would be, why isn't this in Axiom? Crescent is a pan-Asian manager, whereas Axiom focuses more on country-specific managers. I think they are looking heavily at Crescent, but it's a little bit out of their mandate to have these more regional pan-Asian managers. Crescent we've been speaking with over the last year. Think highly of the team. We had met with David Hand, the head of the firm, and Helena a couple times. Our view of this firm was really strengthened when we did an on-site in Asia. We met with his 2 lieutenants, Quinlan and Jason, who I think are superstars in their own right. Met with the analyst team. They are very impressive. I think they could be at any firm they want. They drove me and Ethan into the ground as far as talking about deals, talking about macro, top-down strategy. Very impressive team. I think that's a major benefit of on-site, where if we were doing desktop due diligence and only meeting managers here, you really only hear the stories from the head of the firm.
Michael, tell us where exactly was the on-site? Where did you go?
Singapore.
Singapore, it's a long way from here.
They speak a different language.
We lose a lot of time. You lose 2 days flying over there, so it's a a tough fight, but I think when you find a manager like this, it's worth it.
Michael, I don't understand the description of growth equity in special situations. What does that mean?
Growth equity for them will be minority investments where they don't have control of the company. They are investing in high growth companies. In general, that would be anywhere from 20 to 50% year-over-year growth, top line. Predominantly, it will be China focused as far as growth equity. Special situations for them will be more value, point in time type of investments, and they'll be more focused on Southeast Asia, whether that is Indonesia, Vietnam, Thailand. So,
Michael, this is a smaller type firm right now, and there's 4 partners. How many other people are in the firm?
yeah, so right here you can see, this is a little bit of a new format. I'll talk about that in a second. There's 29 people in the firm, 15 on the investment team.
Where do I, oh, I see, oh.
That's a new thing that we added. We took that from the public team's profiles.
Oh, I like that.
Another thing you notice is the board briefs are slightly different from previous.
The what?
The board brief, this page.
Oh, okay.
Historically, they had been 2 pages. We've slimmed it down to 1 page and really tried to focus on what might be viewed as most important to the board. Hopefully it's more digestible, but please let us know if there's anything you'd like to see in there. We did include the LPAC, or LP Advisory Committee board seats that we're taking. That's on the bottom right of fund overview.
So at $50 million, we're a fairly significant investor in this.
So we have an LP advisory seat on this. I'll say for the majority of funds that we're investing in nowadays, we are a significant investor. I think the GP community views us as a very strategic partner. There are the New York Commons, California pensions, Washingtons of the world that are just too big to invest in funds like this. When they're doing $200, $300 million checks, they're just not able. A lot of GPs are seeking Montana for various reasons, but viewing us very much so as a strategic LP. I've heard the term that people view us as a next generation LP, where our check size is large enough to be meaningful, but not so large that we can't access interesting managers like this.
Sounds like good opportunities.
It has been.
Yeah.
It turns out not to be all that much money in terms of the fund, but could you explain the decision-making process that makes you end up with 20 million going into one fund and 50 million into a different fund?
Yeah. So we rely on RVK for pacing studies to make sure that we are within range and to hit strategic allocations. There are variances between the various pools. So the private equity pool is the largest. So the check sizes there are generally larger than what you would see in real estate. And then natural resources is the newest and smallest. And so the check sizes there are smaller. We have been, over the last year, trying to focus on larger check sizes, less names in the portfolio, so that we are leaning into our highest conviction managers and spending our time focused on those relationships instead of maybe over-diversifying with so many names. I don't think diversification is certainly important, but at this point in time and with the maturity of the portfolio, it's 177, 175 plus line items, we're not in need of major diversification. It's probably the opposite, where we need to lean into who we think are the best managers. Does that help? I think we'll also have further discussion around pacing at the real estate asset class review and then the asset class review in October.
Michael, is this management fee part of your negotiation process?
It is. I think for every single manager, generally there is some negotiation. sometimes it's not just around fees, sometimes it's more around terms. If there are any questions, I'll move on. Next one is Deerpath Capital. They focus on lower middle market direct lending. This is a credit-focused strategy. Might sound familiar because I brought it up the last time. We, post that discussion, have decided to commit an additional $30 million. That was a function of the aforementioned, us wanting to lean into the best managers. Instead of picking 5 credit managers, we would do less, maybe bigger check sizes. In this case, we were able to negotiate a lower fee. We have a 10% discount on what's stated here on the carried interest and the management fee, which are very low, probably below market standard already. But because of our size and I think value as a strategic partner and being an anchor in this fund, we were able to negotiate a lower fee. Next, Blue Sage. This is lower middle market buyout. By lower middle market, they're focusing on companies that have EBITDAs or net earnings of $1 million. So this is a part of the market you can't access on the public side. This is what RBK was talking about earlier. This is pretty close to the bottom of the smallest companies you can invest in private equity. I think very highly of this team. They have 2 funds behind them. Very high demand funds. Did not use a placement agent. Sourced this relationship through being in Austin, looking at the life settlement manager. So that's another benefit of traveling, is developing new relationships. If they didn't have a placement agent, they probably wouldn't have connected with Montana unless it was us being out in Austin.
Michael, could you describe a typical firm the Blue Sage might invest in? These small founder-led companies?
Yeah, so usually they'll invest in a very niche firm, quite small, so it might be a specialty parts manufacturer for high-speed boats. And they would invest in maybe the top 3 companies there and look to consolidate that fragmented industry. Or they might do waste disposal in a fragmented Texas market where there are hundreds of waste disposal companies, each focused on a particular city, and they might try to roll that up. Or they might do a gardening services company in Oklahoma. Very, very niche and small businesses we would all recognize.
And this is their 3rd fund, did you say? And it's 173 million. How big were their other funds?
So 173 million is their active AUM. So the other ones were 225. They had 2 SBA funds historically. They can utilize 2-to-1 leverage, so the effective buying power of those funds have been 225. So they have a long established track record, a trail of success and showing an ability to deploy this type of strategy.
And so what type of leverage do they do?
So I think Blue Sage, what really impressed us is their track record through the GFC. They're certainly top quartile by a long shot, and performance is very strong on an absolute standpoint as well. And that's really because they are focused on using low leverage in their portfolio companies. What does that mean? It depends on the company and what it is. I would say more market standard leverage that you see in leverage buyouts is 50%, maybe 55 think they're more focused on the 30 to 40, maybe a little bit higher for a very stable, non-cyclical type company. I would say in general, their leverage is lower than the market.
Are other of their investors public funds or?
Yes, the largest investor would be Texas TRS, and has been their anchor strategic investor historically. So there's certainly an institutional base behind Blue Sage.
This is the team, I really like your investment term. I can never remember the waterfall thing, so thank you very much.
Yeah, and that was done by our summer intern, Great. She did a good job.
So one more time, Michael, how'd you find these guys?
So I was in Austin doing an onsite for Vita Capital, the life insurance manager. And then I went online and looked up the SBA website to see who they issued licenses to. There's probably 100 names that they have licenses to. And looked up the 2 names that were in Austin, Dos Rios and then Blue Sage. And then I reached out to Blue Sage. This was over a year ago. I attended their annual meeting last year, which was for existing investors, but they invited us out, and so slowly built a relationship. We were early on this one, which was a good thing. We were able to negotiate a lot of the terms. We essentially anchored the limited partner agreement and the legal terms of this deal. We're in the first close. We've done multiple references with them from other investors. And I don't think, we would have found something like this. Maybe I could have called all 100 names and had, phone conversations with them, but it was really because I was in Boston and looking to build relationships. So that is a major benefit of it.
You said you called the 2 that were what?
The 2 that have licenses in Austin.
Mr. Chair, that's one more question, and it's on Vita. We're a year into that $40 million commitment. What are you seeing there? Because that's an unusual, this is the viatical buying the life insurance of people that are dying, which has been controversial. So I was just wondering how it's going.
Performance has been very strong, quite a bit above expectations. I guess what that means is they've been able to enforce policies sooner than expected. And so there's been quite a bit more realizations than expected, so it's been performing extremely well. I don't suspect that will continue if I come down a little bit, because it's hundreds of policies, but today it's performing very well and as expected as far as the strategy goes.
And has all our capital been called on?
It has not. It's probably been called down faster than expected. I think a little bit of that is the opportunity set that they're looking at. So if you remember, it's kind of a 2-pronged strategy. One is buying a tertiary pool from financial buyers, so pools of assets, and then the other is buying more individual assets from brokers. The tertiary pool has been very strong, and so they've been deploying a lot of capital there. Maybe even too much in my view. Would like to see a little bit more balance instead of just buying on the financials or from the financials. But overall, it's been good. I would expect them to deploy the rest of the fund over the next 2 years or so.
Thank you. So I have a question about that. If you're on the LTAC program, and you say you're buying more in the tertiary pool than your preference, as a member of the committee, do you get, when you go to those meetings, is that what you do? You say, why are we doing this?
Yeah, absolutely. And then I yell at them and ask them stuff, and it's up to them ultimately to decide what they want to do.
No, I understand.
But we certainly provide input on that. The other LPAC members are Arizona and Michigan, and we speak to them at sidebars. So there's certainly quite a bit of influence from the LPAC. We can't necessarily control the strategy, nor would we want to, but we certainly provide input on what we think is for the entire partnership, not just GP.
Thank you.
Thank you.
Thank you very much.
Investment update, that's you, Andrew.
Well, I'll kick it off.
There you go.
Good morning, Mr. Chairman, members of the board, Joe Cullen, CIO. We'll be turning to tab 12, the investment update, really review of recent time period with a focus on the last fiscal year. But before turning to those pages, I just wanted to make a few additional comments, somewhat questions that I may expect to get or from yesterday's discussion. So really looking forward, right? Things have been good. Looking backward, as you'll hear more today, returns but are we concerned about the future? Simple answer is yes, right? But that in itself isn't a concern because we're always concerned, right? We're always looking forward and we're focusing on our fiduciary duty and always making decisions that we believe are in the best interest of the pension plans and the other assets we manage. So it is, it is our job to manage risk, not avoid risk. And although returns have been strong recently, there is significant risk in the market. And although we don't predict in the nearer term that the markets are going to go down, 20, 30%, or we're going to hit a recession nearer term, that's not our focus to predict those things. We do expect at some point in time those things will occur. And so we continually try to improve the process and prepare for those type of events to protect the downside of the portfolio at the same time when they occur, hopefully use it as an opportunity to make investments at those times when the markets may swing too far to the downside. So there's a lot going on. You will hear today about more diversification and some of the things that I will cover. I will demonstrate how we are being more diversified in the pension plans across asset classes. We will hear from others about, as you just heard from the private investment team, we continue to increase the diversification across asset classes. Even at the same time, we're increasing the size of some investments, but we're doing things that we haven't necessarily done before, investing in a debt fund in the private space and some other things in the public space, the real estate fund, the Fidelity fund that Terry just mentioned. So we're continuing to diversify risks at many different levels and we'll continue to manage those risks going forward. So yes, we're concerned about the future, but we feel well prepared to kind of move forward and manage those risks. If I could ask you to turn now to tab 12, and I'm going to go through this pretty quickly because a number of the slides that I have will be reviewing some of the things that RBK and actually CDM to a certain extent went over yesterday. So page 4 of the presentation has the returns, focusing because it's a fiscal year end on the 1-year number. You'll see that the returns approximately 8.8% are good, 1-year return consistent with longer term kind of objectives. It's also important from your standpoint to see the consistency across the plans, right? They all have the same asset allocation, and that's much easier these days because of the cap structure and how we're investing in that. So the volatility in these numbers, the basis point or two, is really driven because plan to plan there are slight differences between what percent of cap they hold versus what percent of STIP. And that's not us determining that, that's really determined by their cash flows on a month-to-month or quarter-to-quarter basis. So it's in the neighborhood, some plan might have 98% invested in cap and 2% in STIP, and someone else might have 2.3% in STIP 97.7% in cap. So the process is very tight, and these numbers are consistent with that. More importantly, you know, as we move forward in time to look at the 5 and 10-year and 20-year number, and since inception, again, it's important to look at the 5 and 10-year, because the 5-year, we've only had really good markets over that time period. The 10-year still includes the 08 period, and so those numbers are a little bit below recent numbers and the longer term actuarial assumptions, because they do include the last down market. As we look forward the next 10 years, it wouldn't be, as I said a few minutes ago, it wouldn't be surprising to see another downturn in the market in that time period. So that number is still a very good number, given you know, a market cycle of both down and up markets. And then lastly, probably the most important number as we go forward is the since inception. It's kind of what have we done over the very long term, because that's what's being built in as the plans themselves are planning. And those numbers don't change that dramatically over time. These because of the, in this case, 24 and adding as we go forward. So those numbers are very consistent with the past and current expectations of planned returns. Any questions about the planned pension returns? Turning to page 5, this is also important, and maybe in some ways most important, because it's you know, the plan's objectives are to pay benefit payments. So if you look on the left-hand side of page 5 over the 1-year time period, you'll see that red bar, which is focusing on the net cash need. $324 million in aggregate of dollars came out of these plans to pay the benefit payments. That's why we're doing this, and that's a meaningful number, but not a concerning number. You know, it's approximately 3% of plans. That's less than what endowments and foundations will pay out on a regular basis. So it's not a concern. Risk management, we'll talk about that in a few minutes, how we think about that from a liquidity standpoint. But that net cash need is what we've paid out plus the contributions coming in. So it's a net number. As important, just to the left of that, the dollar value added, the 958, so almost $1 billion because of the income and the appreciation over the last year. Again, a good year return-wise, and you can look to the right to see the 5 and 10-year numbers, and all of that is a good story. So I don't have anything else to add there. Page 6. Again, just another view, bottom right-hand corner, year-over-year change. These plans in aggregate went up $634 million after paying out benefit payments. Page 7, I think Jason showed this a little bit yesterday as part of the high-yield presentation. The key thing here is we picked out one of the plans, PERS. You see that in the gray box, and their returns. And you will always should expect them somewhere in the middle, never at the top, never at the bottom, because it should be an average of these other asset classes. And the returns have all been good there. And to a certain extent, these type of slides are very helpful, and as you see these different colors moving around, it's maybe less helpful at this point in time because all of these time periods have really been positive for the markets. Maybe a little bit more telling is if you go to page 8, and although even the last 5 years have been positive, if you focus on fiscal year 16 as an example, fiscal year 18 that we just finished, all is good there, and you can look at those numbers. But if you look at the middle column, fiscal year 16, you'll see the PERS pension plan at that time was at 2.07%. So positive return, so again, not overly concerning, within expectations of what we think plans will do, even achieving the longer term returns. But as you look at the stack there and what's at the top, and you'll see the top more heavily influenced by the asset classes that are more fixed income in nature. You'll see U.S. equities did pretty good, but towards the bottom, you'll see the non-U.S. equities, which is MSCI, ACWI, ex-USA, and the MSCI, the commodities, natural resources, and even the U.S. small cap. So even during a good period of performance over the last 5 years, you can have some times where certain of these asset classes will go down. And that's what diversification is about, right? Things are always going to go up together, and thankfully things will not always go down together. So again, a good story, but just wanted to point out, because as we move forward, we do expect years that both the pension plan and these asset classes will have negative returns, but we feel confident in our process to manage through that.
Thank you for the legend on
Yes.
7 and 8.
Yeah, it's more important to even just look at the colors than the text.
Right,
Legends
I get confused with the acronyms and the legend is great. Thank you.
You're welcome. Nothing to really say about page 9 other than just confirming we're all within the approved ranges. So nothing else to say there. Maybe more instructive is to look at page 10 and see how things have changed over the last year. If you look at the, I guess, red or maroon kind of bars that go to the left, those are the negative outflows, so the asset classes that have decreased in their allocation, the largest one being actually investment grade credit. And reason we took assets out of there, the fixed income team doing the credit research and seeing what they would getting paid to take that type of risk, decided to take some of those that risk off the table, and you'll see that an increase right above it in U.S. Treasuries and agencies. We moved some of the dollars from investing in corporate bonds to just less risk in investing in the Treasuries, the agencies. It was on the margin, but it's a time, and still continues at a time we think spreads. The amount we're getting paid to take that risk is relatively tight from historical standards, and it's just another way how we're preparing for future things that could be negative events and could cause spreads to widen or yields to rise, which are challenging environments for bonds, but not really on the margin, and but that explains that move. Yes?
Mr. Chair, I was just going to ask about real estate. Is that simply because the others grew more? We didn't take money away from it?
It's mostly that case that you're talking about, and if you look at page 11, you'll see the asset class kind of returns, and you'll see real estate was up 7.6% on a time-weighted return basis, and which is a good return, but below the other equities. So it is mostly that. There is, we continue over time, because in our non-core real estate portfolio, we continue to get distributions. It's been a good environment, so that has contributed to it. And there's one core manager that we've been slowly over time getting out of, which is the TIA fund, the cities fund, and so, but mostly it's what you've noted, that it hasn't appreciated as much as some of the other asset classes. Domestic equity, we have for the entire year, and actually a longer period, continued as we pay these benefit payments. That has been the source of capital, and we continue to take money out of there, but it keeps going up, right? And so good problem to have, but we will continue to keep pulling money out of there, and that's why that is slightly negative. And yes?
It seems a little bit counterintuitive to increase the allocation to treasuries and agencies when interest rates are moving up. Can you explain?
Sure. So our overall investment in fixed income has remained relatively stable throughout the year. These specific investments we're making are all intermediate term in nature, so their duration tends to be a little bit shorter than the overall market. Generally, the maturities are out to 10 years or in. And so as I mentioned before, the change was really moving from the intermediate corporates into the intermediate treasuries, so that didn't really have an impact on the interest rate risk. The duration of those two asset classes are pretty comparable. It was more of taking risk off the table, less in corporates and putting in treasuries. So generally speaking, probably relative to where we've been historically and relative to peers, we probably have less interest rate risk in our fixed income portfolio, given we're still closer to historical lows in rates, and rates seem to be rising. So we're cautious of that risk, but we haven't exposed the portfolio more to interest rate risk. We've probably decreased it over time.
I may just add on that, Representative. You'll see on page 9, our total fixed income is 23%. We have a 15% minimum floor, and that's all fixed income. That's still pretty low for us by historical standards. To show my age, in the 80s we were 60% fixed, 40 stock. How the world has changed. In those days you could get an 8% coupon, but we're pretty thin on fixed income, given that we haven't really get paid very much for it, but it's still a very important component of stability and liquidity.
Yeah, and as you know, hope is not a strategy, and we're not spending a lot of time in terms of prediction. But you know, if the market turns out to be right, that interest rates do go up over the coming years, expect us likely to have more in fixed income, and we will not try to time the peak in interest rates, right? But as rates go up, we will be getting more income, more yield, more total return from fixed income going forward. The closer those returns from expected fixed income become to our actuarial returns, they'll play a bigger part in the portfolio. And so if we get back, hopefully not the reasons we had higher rates, you know, years ago, the type of inflation, but if we get back to interest rates being a few hundred basis points higher than here, expect, as we look at this type of chart on page 10 going forward, that we will be moving more dollars into fixed income.
Joe, we're cutting back our allocation in mortgage-backed securities, as you mentioned. And I guess I'm wondering, how does that square with our private equity investment in Fidelity that invests in that kind of asset class?
Yeah, so a few comments there, and I don't want to get too far into the weeds, but some of that decrease in mortgage-backed securities is the same reason for real estate. It's kind of stayed flat as the rest of the portfolio has gone up, and so it's not like we've taken so many dollars away from it. It's just the others have gone up, and we haven't added to it. At the same time, like corporate bonds, as I mentioned, we believe that what we're getting paid there relative to treasuries and mortgage-backed securities, it's at relatively tight spread levels, and so on the margin we have reduced that a little bit over the last 10 years, right? The Federal Reserve, part as a response to the last crisis, added to their balance sheet. They have been a big purchaser of mortgage-backed securities. They have announced that they will be reducing those holdings on their balance sheet, and so we've been cautious to kind of add there. So these mortgage-backed securities that are here are really residential mortgage-backs, individual homeowners. In our real estate portfolio, and specific to the Fidelity high-yield investments, those are more aligned with what we do in our real estate portfolio. So they're Not generally, single-family type home ownership. They might be multifamily apartment buildings, but more likely office buildings and industrial buildings. So they're referred to as CMBS, so it's commercial mortgage-backed securities. So there is some difference there.
Okay, thank you.
And I already referred to it, but on page 11, just gives you the snapshot. Again, good picture. You'll notice almost all the asset classes have green bars. The ones that don't are very small, negative U.S. Treasury, agency, and investment grade credit, and you'll see those bars slightly negative because interest rates have risen over that past year. So that's all I have. Before turning over to risk management, happy to answer any other questions, but you'll hear a lot more about the broader portfolio and each individual asset class as others come up here.
Well, I had one question, and that you explained the domestic equity maroon bar.
Yeah.
Is there any idea that, coupled with that we are slowly cutting back on domestic equity as a defensive mechanism?
Yeah, so if you turn back to page 9 and you look at the top line, domestic equity, you'll see as of June 30th, our current percent was 36.1% within a range of 24 to 38. So we're at the high end of the range. And we have been for a while, and we keep selling to make sure, and we've actually tried to have some efforts to reduce it further from that high end of the range, but each time we do that, good things happen and the market goes up more. So we will continue to be within kind of the midpoint to that high end of that range, but we are taking actions to, given opportunities in the market as the market goes up, to reduce that. But again, good problem to have, right? We have been selling, but U.S. markets continue to be the best performing markets. Does that answer your question?
It does.
Okay. So let me turn it over to risk management team to go over the next section. Thank you.
Morning. Well, Mr. Chairman, board members, I'm Dan Zarling. I'm the Director of the Risk Management, and I'd like to continue with a little bit what Joe was saying and talk about performance attribution. So I'm on slide 12, and this is another view of our performance. This is showing our contribution to return. So this is where we're taking the weight of the asset classes time to return and taking a look at how this stacks up and adds up to our total return. So as you can see here that it's our equity asset classes are contributing the majority of our returns. And in fact, it's over 90%. If I look at that compared to a year ago, that was over 90%. So not a lot has changed here. And we're going to talk about this, but we do have a home bias that there are risks associated with equity. We're well aware of it, but because risk and returns are different sides of the same coin, so to speak, this is the trade-off that we discuss every day, and it's working out, would be my view of this. I will say that it's a scaling challenge when equity does so well, and fixed income is doing well, but not to the magnitude of say, equity. So it's just that in this slide we have different slices of fixed income, and I didn't mean to try to show that fixed income was not contributing to the performance of the portfolio. If you add up all of our fixed income, it is a positive contribution, something like 0.03. But The point I'd like to make is that fixed income plays a very important role in this portfolio, that it adds stability, it's the balance of the portfolio, and it's not to say that, that fixed income is always going to have a, say, a negative correlation, which is again what risk management is looking for to equity, because sometimes, like in the great financial crisis, when equity is going down, fixed income can go down with it. But I just wanted to highlight that it does play an important role, and that it has an element of liquidity in our fixed income, especially in our cash or the STIP portfolio. That's kind of very important to the portfolio, and I'll talk about that later. So, are there any questions, Ken, on here? Then let me just jump to the next slide, 13. This is how we monitor our concentrations by manager. Not a lot has changed on here. It shows that BlackRock is by far our largest manager. They basically have our passive funds with BlackRock. I think it's the largest investment manager out there. So we have a lot of confidence that they have their operation in top shape. And then again, we just list these other ones. My only comment would be that, like JP Morgan, we color coded this so that you can kind of get a sense of the different asset classes with the various managers. So for example, JP Morgan has done very well with our 130/30 equity portfolio, and we have a core real estate that's done very well for us. So in combination, it shows that JP Morgan is our largest external manager, an active manager, and the reason why we keep tabs on this is we make sure that our managers are staying with our compliance limits of, say, 5% of the total portfolio. So again, this to me looks very reasonable in terms of nothing looks real extreme. I know we have a lot of money with internal fixed income. And my other comment here is that State Street gets the colorful rainbow. That's because in this type of analysis, so they manage the STIF, or a cash vehicle for each of the asset classes. So that's why it shows up in various colors here. So the cash management, which is the sweep vehicle, is in each of the asset classes. Plus we have some ETFs, the spiders with State Street. So that's just a little bit of an explanation.
Is this the average throughout the year or a snapshot on a specific day?
So this is a snapshot, so yes, it would be as of the end of the fiscal year.
As of the end of the fiscal year.
Yeah, again, Carl, I mean, this doesn't move a whole lot. There's going to be some market value changes, but we just haven't been actively, repositioning managers, if you will. So this really is a kind of a function of kind of our initial investment with the manager and market values. And then we're looking across the entire portfolio. So that's what gives us a kind of a different view than just looking at each asset class and saying, who's our biggest concentration. I think going forward with our asset class moves, that we are going to be reducing our exposure to BlackRock. And again, that's just a function as we try to move into the area that we're adding incrementally to, such as private equity and real estate. Or even if we're going to be paying pension benefits from the domestic equity class, our first place to take that cash is in BlackRock. Any other questions here? That's good. Okay, so my next slide, 14. This is my geographic concentration, my geographic view of the entire pension portfolio. And again, it's just going to highlight, well, again, I've monitored this because we realize that there's some inherent risk if you are going to have some international exposure. There's some inherent risk if you are, have a U.S. exposure. But this is really trying to give you a relative sense to a global equity benchmark, and that's the MSCI ACWI IMI. and you can look that up in the glossary, it's a real mouthful, but that is a global benchmark that we subscribe to, and it's just giving you, those kind of relative weights as to what our portfolio looks like. It's a little bit unfair because a global equity benchmark is not going to have, say, cash in it or treasuries and things like that. But I can show you how that looks kind of on the next page. But this is driving home the fact that we have a home bias and giving you a little bit of sense of how big of a magnitude that is. And again, it's at the moment this is working well. I'm not concerned about any type of extreme that I see here. I don't have to worry necessarily about foreign currency and what's happening to the Turkish lira, I think it is. We just don't have a lot of exposure there. This is an overall view, and in fact, if I took a look through and just, if I wanted to say, well, how much exposure do we have in emerging markets, I can look at that on a daily basis. We're at about 4%. This is for the overall portfolio. If I look at it from this global benchmark, emerging market represents about 11%. And again, this is just strictly an equity benchmark. Internationally, emerging markets, I think, comes out to be about 24%. So the takeaway there is we're not taking a lot of risk by an overweight position in emerging markets, and given how well they've been doing, like RDK was mentioning, I'm glad we don't have an overweight. So again, it's said that we're in the right place in terms of where we're getting our returns. That may change later, in the future, because these are the opportunities that arise. But we have to kind of look at that trade-off, and that's how we decide our asset allocation moves. So any thoughts on this, or clear for everyone? Okay, so my next slide is the sectors, and this is where, again, I've already mentioned that hey, we have a pretty large weight in U.S. Treasury. That's again, that represents kind of our say our one-day cash or a very liquid type of investment. And when you put this all together, then you can look at our weights by sectors, and hey, the highest weights, no surprise, with technology and financials. We're overweight in real estate, but that's in part, I mean, the real estate market globally is a huge addressable market, and we'll talk more about real estate later. But it's interesting that the real estate sector has just recently been added to the GIC sector, the way everyone kind of views the equity world. It used to be buried in financials, so it's not quite comparable to history. When you look at the extremes of these sectors, say back in 2000 and things like that. But again, I just think that when they finally carved out real estate, here it is at 4%. It's not it's just going to note that it's not a big part of the benchmark. And again, I look at this and say, well, our real estate exposure, and this is again looking across everything, so it's public as well as our private. It's still reasonable. It's within our range, and we have a kind of a processing plan to increase our real estate exposure. So hopefully that gives you a sense of our concentration by sector. On the next slide, I'm just showing the top 10 securities. This is color-coded. Again, it just dovetails with the fact that some of our largest sectors being technology and financials, and some of our largest individual security holding is going to be tech and financial. But when you just try to look at the scale of this, I don't see anything really extreme, and it's very reasonable in terms of positions on an overall basis. So now I'm going to turn to slide 17. This is my, I guess it's a new slide. It's just my attempt to give a quick liquidity analysis. And for this, I'm trying to show two examples of kind of what are their immediate priorities, if you will, for cash. What are our cash needs on an annualized basis that Okay, so the risk management team is going to say worry about or make sure that we have enough liquidity for certain things. And so the first one, again, these are kind of my back of the envelope, but the first one is our net cash need for pension benefits. So if I just take my current run rate on a monthly basis, it ends up annualized, it ends up to about 360 million. And we have to make sure that we have that in a sense in say 1 day liquidity, at least we'd like to, so that there's always that comfort that we always have that available to pay on an annual basis, even if the rest of the markets are going crazy or going down, and we just prefer not to sell at that time, we can tap our liquidity for that. Another example, and there's some different views on this, but the other example is I just wanted to highlight that the 175 million represents a rough cut on when we talk about asset allocation moves. I know that kind of what's in the works, if you will, is that we're going to be increasing private equity, real estate, natural resources. And if we're going to be able to get the weights to kind of where we think they should be, say on a 3-year basis, if I just look at it on an annualized view, I know that we need about 175 million of NAV in total in our illiquid portfolio to kind of bring the weights up to where we'd like it to be. This is the subtle asset allocation changes that we made. And because this is incremental, I got to think about, well, do we have available cash to make that move, or do we have to take it from another asset class? Now, my preference is that we have enough liquidity, enough flexibility to take it from a 1 day liquidity, so there really isn't pressure or we are forced to sell when we don't want to. So again, this is a rough cut. So it's about 535 million, and this number could go up, it could go down. I mean, it could double, is what I'm trying to say, if things change or, you know, as we shift things around.
Mr. Chair?
Yeah.
So am I understanding that you want to have then in 1 day liquidity an entire year's worth of pension?
Fair enough.
Is that what you're saying?
Yes, yes. I mean, it's kind of that, again, we want to make sure that we are not having to force to sell an asset class when, say, the market is down. And one way to view that is to say, hey, as a margin of safety, as kind of a range where we draw a kind of a line of, we should really have 1 day liquidity so that we can pay pension benefits, net cash need for the entire year. Because and again, it's kind of worst case scenario, right?
But it's not in cash, right? So
Cash and treasuries, yes.
oh, so you're counting treasuries. So then you're saying, what you say, you don't want to be forced to sell an asset.
Right.
But you would have to sell treasuries.
Right.
Okay, got it.
Yes. And that's a good point. I mean, maybe we can just jump to my next slide, the pension liquidity. My 1 day liquidity, I mean, we're showing up my asset class, so I guess you can kind of get a sense that that's, the bulk of that is U.S. Treasury. And, you know, that's going to be the deepest liquidity of any asset class that we have, right? And you know, money market securities, we know that we can sell those in a day without too much trouble. And again, I didn't really put the numbers on here, you know, because it doesn't need to be super precise, but it's to your point that our 1 day liquidity at about just over 15%, it represents about 1.8 billion. If, in fact, we did nothing else with our 1 day liquidity but pay pension benefits, and this is how I kind of stress this, you know, in just top of mind, then we, you know, it works out at 360 million a year. That we have about 5 years that we could pay, if we were selling our treasuries in cash, that we could make pension benefits. Now, I don't think that's going to happen, and again, that represents a very large margin of safety. It represents that, you could call it even dry powder. That one's in the glossary. And that, you know, it just means that there's some value in having flexibility to deploy cash into an investment opportunity fairly quickly without having to sell something and kind of be forced to evaluate the liquidity of that type of.
Well, that's a really interesting way to look at it. 5 years worth. That's
Yeah, but the point is that you're within range
Yep.
on all of these investments, and all you're doing, so pardon me, but what you're doing is then looking at those ranges and saying, how do we stand up in terms of liquidity, right?
Yeah.
So, I mean, we're not, we're managing to be in range, correct? And to Joe?
Yeah, so we're managing to be within the ranges, but at the same time, those ranges are asset class defined.
Right.
The asset classes in themselves don't strictly define the liquidity.
Right.
But so as a additional dimension, we are looking at liquidity and understanding and getting comfort that we have enough liquidity that if things do unexpected things, we would not be forced to sell assets at distressed levels. Because even in fixed income, if interest rates go up, we don't expect those to do it at a distressed. We don't think interest rates are going to go up by 500 basis points, right? 5%. So we want to be sure we're never forced to sell.
Right.
And so that liquidity is just an additional dimension, but it is all within the context. We're always staying within those defined ranges.
That's what I'm saying. I think it's really an incredibly strong thing about the portfolio that I'd never kind of connected on, that we're being able to get 7.75%, 7.5% return, but we have 5 years of liquidity. We could wait out a stock market cycle. I mean, I just think that's cool.
Yeah. Well, there's another element of it, just to make it a little more complicated.
That's good.
You gotta hear it. We need liquidity for benefits. We also look for liquidity calls,
Yeah.
for capital calls. Ethan, how much have we got in committed capital that we're contractually on the hook for?
It's just north of 600 million, if memory serves.
We got 600 million that we've said yes to.
That's
That
2
they-
years worth.
So, I mean, I think it's still a good picture, but, just one additional comment this side. We use the same, we think about this in terms of meeting the state's bills, and so John Ramosko may want to remind us what kind of liquidity thinking you use, because we also have a lot of mindset as far as coverage for the state's bills as well.
Question more generally about the risk management aspect. That's your department.
That's me.
That's you. So what I'm trying to figure out is, I'm guessing that you don't sort of initiate any purchases or sales or sort of any by yourself. So how does this work? And I mean, is it a weekly? Do you do a weekly report, or how does everybody know what you've concluded from time to time about what we're doing with the purchase and sales of assets? Do you know what I'm saying? It's kind of an internal question that may not be relevant, but I'm just curious how that works.
Well, right, so I mean, again, we're involved with compliance, so we need to authorize certain trades and everything, but whenever we're going to be moving cash, purchase and sales, say from one asset class to another, we have to go through a chain of authorization. Mike Pettit has to put that forth. Prior to doing that, we're going to have a senior team meeting to discuss, hey, we need to move, cash to this asset class, or we kind of decide in advance, it's planning at the senior meeting, or if we need to do it very quickly to raise cash for a capital call, something like that, we can do it, but it's basically, mechanically, it has to go through the operations group, has to go over to accounting. But before that happens, the senior team has to talk about it, and we have to kind of approve it, the risk management team. So again, any type of transaction that kind of buy and sell.
We're checking the chain of events that
Right.
checks it for risk.
I mean,
Correct.
operationally, compliance has to use their okay before we approve certain things. I mean,
Right.
that's a check and balance we didn't used to have, but we now have.
It shows on that screen that literally they can't make a trade if Tim doesn't say yes.
But yeah, and then again, so, I mean, we can talk about this informally, but we can also kind of open up our spreadsheet that says, okay, you know, what would you like to do again? And we can do a pro forma, see if it's going to trigger anything with our compliance limits. So we can run it through a number of tests, but again, a lot of security trades, or a lot of them, all of them have to go through Bloomberg. And again, that's where Tim is going to be checking those specific security constraints within the fixed income.
I think Joe had a comment.
Yeah, I was just going to add, I want to make sure everyone understands that risk management goes beyond compliance, right? We don't want to crash through the guardrails, but at the same time, you know, we want to stay on the road at the speed we want to stay on, right? And so risk management, and Dan and Aaron as part of the risk management team are looking at things on a daily basis. Everyone else on the investment team is considering risk themselves within what they do and thinking about that on a daily basis. And as Dan mentioned, on a regular basis, the directors and myself will get together and talk about the risks and the opportunities in the portfolio, and that's ultimately what will drive the asset allocation. So risk management is ongoing, and it's a collaborative effort and done by everyone, but Dan and Aaron on the risk management team are really focusing on it, in some cases to play devil's advocate to others on the team as a check in the process.
It's a good metaphor. You might want to tell Jim that you...
Yeah, I would add to that again, you know, we're thinking in terms of, again, the worst case analysis. We're looking at different scenarios, and for the whole portfolio, what would be its impact? You know, we're working on trying to quantify those exact numbers so that intuitively what people are thinking in terms of a stress scenario, does it prove out quantitatively and, you know, strictly a model? And we're in the works, and we have to discuss this and kind of rerun it and work with the systems that we have. But that's what we do. And then I want to assure you that I do drive very slow. I don't.
You asked for it. That's your fault, Diana.
It's there.
Any other thoughts, comments? All right, thank you.
All right, thank you. Good morning.
Morning, Mr. Chairman, members of the board. Representative Hamilton, welcome aboard. I am on page 19, and as I have historically done, I'll tend to move through this pretty quickly. I won't bore you with the gory details. I'll leave it to the high points, but certainly we'll answer any and all questions along the way. So with that, private equity. Reading through these bullet points, you'll note that volumes remain high across private equity. Global M&A prices have come down slightly, but still remain at elevated levels. The IPO markets are strong. Yes, ma'am.
So what does 1H18 stand for and 1H17? I know they don't know.
First half. First half 17, first half 18.
We got maybe one heartbeat.
But we wouldn't last very long with that one.
Thank you.
Of course, certainly. The IPO markets remain strong. Secondary market volumes are strong. Prices remain elevated. Are there any questions on this page that I can address specifically? we'll move on. Part of what's driving prices to such high levels, debt remains plentiful, terms remain easy, debt multiples remain high, dry powder is high. Fundraising has tapered off a little bit, but I see that simply as a point in time. The fundraising market generally has been very robust, and I expect it to remain so, particularly given the strength of the public markets. And a lot of folks out there are chasing their private equity allocations and committing more and more to the space. I wouldn't put us in that camp by any means, but certainly it's a dynamic that I have noted in the market of late. While private market remains, dry powder remains high and is a bit of a concern, prices are high, competition is high, somewhat reminiscent of 2007, 2008. It also leaves the door open for a lot of people to transact and for folks to winnow through the existing asset base that is in private equity now. And so it's a bit of a double-edged sword, is sort of how I view it. As we look at managers, we want to focus on those that have proven themselves through cycles, proven ability to add value at the portfolio company level, and aren't just using financial engineering to arrive at a return.
Mr. Chair, 2 questions. One is, because of the strength, is this a time to look at selling some of our assets on the secondary market as we move out of funds and funds?
Certainly, absolutely. That is part of our role as a fiduciary, to prudently and actively manage the portfolio and not just always be buying, but also be selling, and we have. We are actively looking at a transaction now to reduce some of our legacy exposure to fund of funds, to some of the names where we have low conviction and haven't serially re-upped. That will not only give us the ability to redeploy the capital to new and perhaps better opportunities, but it will reduce some of the administrative friction, not only from a human capital perspective, but from a financial capital perspective. Each fund costs us, I believe it's $1,400 or $1,800 annually to monitor and administer through State Street. So it serves it's a good exercise, and we are always cognizant of the market dynamics and looking at ways to make our portfolio more efficient, and hit the bid, if you will, when the price is right. But there is always a frictional cost to that.
Mr. Chair, one more question. Sure. Could you give us a little bit of background and flavor on the JLL partnerships that we heard about yesterday? Sure, interesting.
Sure, I'd be happy to. So JLL currently is a manager we have conviction in. We are in funds 5 and 7. We committed to Fund 5 in 2005. We committed to Fund 7 in 2015. We committed $25 million to each fund. I would be happy to get you the specifics as far as how much is drawn versus how much is unfunded, et cetera. Most of Fund 5 is drawn down given its vintage year. Fund 7 is relatively new. Fund 5, which is the holder of the subject company Ace Cash Express, which was discussed yesterday, is clipping along at a 1.7 times net multiple, almost 11% net IRR, so has been quite accretive to our portfolio. Fund 7 is at a 1.13 net multiple, and similarly almost an 11% net IRR. That's as of the first quarter. We have, maybe getting a little bit more granular and focusing on some of the comments that we've heard from the public over the course of the last 3 board meetings. Ace Cash Express is a company that was invested in by Fund 5 September 30th of 2006. So after we made the commitment, I'll remind the board that when we commit to private equity funds, they're a blind pool. We typically don't invest in a pre-existing pool of assets. It's discretionary capital for the manager, so we don't have the ability to control which companies they invest in. We knew that their opportunity set included things like financial services, which is where I would lump Ace Cash Express into. During the course of their investment in the company, the CFPB, the Consumer Financial Protection Bureau, has changed some of the regulatory requirements, which I think has brought additional scrutiny upon the company. We are aware of that. We have spoken to the manager about that, JLL. We continue to monitor it. It is something we are acutely aware of on a go-forward basis. JLL is currently in the market now with their Fund 8. We haven't begun a full due diligence process on a potential re-up into that fund. As you will note, we were in Funds 5 and 7. We skipped Fund 6. That was before my time, but my understanding was we had some liquidity concerns and we wanted to manage our capital commitments pretty prudently at that time. I will tell you that while we re-upped in Fund 7, it is by no means a rubber stamp. We subject every fund that we commit to, whether it is a new fund or a re-up, to the same level of scrutiny, the same process every time. I would also offer, maybe just going an extra mile, given the what I would characterize as the increased amount of scrutiny and the public acuity that has fallen upon this board and this particular investment within this fund. I'll just note that, we are very cognizant of the board's reputation. Me personally, I think, Michael touched upon this a little bit in his comments. We have a very strong brand in the marketplace and with all GPs, and I feel it's getting stronger every day, and I think that speaks volumes to our team and our process and how we communicate to the outside world, and how transparent we are with them and how direct and professional we are with them. We are acutely aware of our reputation, and we continually monitor not only how our reputation is in the marketplace, but those GPs that we're invested with, how their reputation can potentially impact us and how the investments they make can potentially impact us. And we want to be aligned with those folks that are cognizant of how their actions will reflect upon their underlying limited partners, particularly folks like us who live in the fishbowl, if you will. I know I've said a lot. I want to make sure I've addressed everything. So perhaps you can guide me from here if there's something else you'd like to know.
I got a couple questions. What was their investments? What's JLL's investment strategy?
They're a mid-market buyout.
Mid-market buyout?
Yes.
Right. Okay. And as I understand it, Fund 5 had the buyout of the suspect company.
Correct.
Does 7 have anything like that yet, or?
As far as predatory lending firms
Right.
may be concerned, no.
Bad people?
So that I suppose I'll qualify that by saying that's subject to interpretation, but as it relates to the suspect company and what's in Fund 7, we have not run into any particular areas of consternation.
All right. And then 5, the duration?
So I believe they are into the second extension perhaps by now. So that it's into maybe even the third, pardon me. So it was a 2005 vintage year fund. I believe the fund term has been extended at least to maybe even 3 years. The typical private equity fund is 10 years plus 1 to 2 one-year extensions at various different thresholds. It could be the majority of the limited partner advisory committee, a simple majority of the limited partners. Our particular policy is not to approve those. So whenever they come to us and say, hey, 6 months, we're at the end of the term, we'd like to extend this, we say no. And partly, well, largely that's because A, we want to see our money back, but B, we want to keep them beholden to the terms that they and we originally agreed to vis-a-vis the limited partnership agreement.
So, I mean, as you're sitting here today, when does 5 come to an end?
So TBD. So they can continue to extend, and we will continue to deny those extensions, but in my experience, I will also inform the board that we have been an extreme outlier as far as disapproving these approvals. Most limited partners, will, for lack of a better term, continue to drink the Kool-Aid that the general partner is feeding them in terms of, well, gosh, we want to maximize value, we need to hold this another year. And we say, gosh, there's value here, why, it's marked at above cost, go ahead and sell it, give us our money back, and, stick to the terms that we agreed to.
Do we sorry, Carl. No, go ahead. So how does that work when there's a split of opinion on that? You said that...
We're typically overruled.
Okay, so we don't
98% of the other...
You get a vote, you
just get a vote.
That's
get a vote by the dollars that
That's
you've
right.
got in it.
That's right.
So you vote no, and the answer is usually yes.
Yes.
So
Correct.
But my question, Ethan, is, and I'm not asking for date specific, I mean, is this something that's going to expire on its own terms in the next year or two?
It very well could, Carl. The last time I looked at data, which was provided by Adam Street, which is one of our current GPs who we haven't done business with for a long time, but still have a remaining position with. They've been a fund of funds manager for the better part of 30 years. They've got data, their data as it relates to their funds that they've invested in, said something like the average life of a private equity fund was 15 to 17 years. So that's 3 to 5 years beyond what is typically contractually agreed to as a normal extension period of 0 to 12 years.
The other question I have is that with all the controversy about 5, and maybe it's true with 7, would that affect its value on the secondary market?
It very well could, absolutely. While the private equity markets are certainly less efficient than the public markets, there's a lot of chatter out there. It's a pretty insular market, no doubt about it. There's one fund in our portfolio in particular that we've explored a transaction around simply because the GP has decided not to raise additional funds. A number of the key decision makers, partners have left, spun out, formed their own firm. Anytime we sort of shop that particular fund around, everyone's acutely aware of it and prices that in. Oftentimes you can, depending on market dynamics, sorry I'm taking another step forward, but you can account for that built-in discount, if you will, by coupling it with other names in a portfolio that might have a higher degree of flow, liquidity, demand in the marketplace, and on a blended basis you can bring pricing up. It's more optics than anything else, but it's a nice way to think about a transaction.
Throw in a draft pick to be named later, is that the
Mark had a comment. Mark?
Well, I was just going to ask if there was any study on returns of the extension versus the alternative of investing that in a new fund. Some type of study that, my guess is you're correct, at least in my experience, that it's kind of the get weight that is left in the fund often.
Oh,
I'm
sure.
not sure if there's any quantitative data that would support that.
I've never seen it. Yeah,
Maybe
no,
interesting thing to look at.
I haven't.
Yeah.
But an interesting thought, yeah.
Sure.
Two quick questions. Is JLL part of the LPAC?
We are not on the JLL Limited Partner Advisory Committee.
Isn't, and maybe I'm wrong here, but isn't there, it's a kind of a badge of honor for a private equity fund now to say that they'll comply with certain things that the investment community's been asking, and I thought that was part of the LPAC.
You may be referring to the ILPA, the
Oh,
Institutional
sorry.
Limited Partner
Okay.
Association.
So is JLL, do they follow those rules?
So it took some finagling and some wrestling back and forth, but they are compliant now with our quarterly request to fill out the ILPA template, which for everyone's benefit is a very robust spreadsheet that on a quarterly basis reconciles the previous quarter end's net asset value to the current quarter end asset value by listing myriad expenses, carried interest, incentive compensation, organizational expenses, interest expenses, legal counsel, consulting fees, et cetera. It's very granular, covers the board, and is hyper transparent. For the board's benefit, that is something that we require on a quarterly basis from all of our GPs. And on an ongoing basis, we will not do business with any general partners who refuse to comply with that, and we require them to agree to that in writing. And if they will not, then we simply will not move forward.
And last question, on these extensions, I appreciate we're one of many people voting, but is there some absolute limit that they cannot extend beyond 5 extensions or 10 extensions?
No.
So really, the end, somebody's there to let us out.
Until they let us out, yeah.
Terry, some of these, they call them zombie funds.
Yeah, at the end of the day, the ultimate hammer, if you will, is in our hands, and we can go to the secondary market and say, enough is enough, we just want to sell this thing and be done with it. But as I mentioned earlier, oftentimes there's a heavy frictional cost there. But you weigh that accordingly, because perhaps you may have, received a ton of liquidity, you've already, received, actually realized, a return that's well in excess of, what you expected, or is certainly accretive to the portfolio. Maybe it's worth just taking that discount, that haircut, and blowing out of it just to be done. And those are decision trees that we embrace on a fairly regular basis.
Is that ever negotiable?
Is
And the front end? That
Yeah, absolutely it is, of course.
You can't have more than X extensions?
Oh, yeah, without a doubt. And in many cases, I'm trying to think if there's a recent example. So what we've recently become active in doing is negotiating with the GPs, particularly where we have a lot of leverage. We are an anchor LP coming into the fund. We will negotiate no fees during the extensions, to the extent
That would be an incentive.
Yeah, indeed. To the extent there's 3 extensions, 3 one-year extensions at the general partner's sole discretion, we'll say no to the 3, yes to the 2, but it has to be at the vote of the limited partnership advisory board, or a majority of the limited partners within the fund. So it's not just the general partner just summarily says, I'm extending the fund. There's at least a dialogue between us and the LP community, or the smaller corporates that is the partner advisory committee.
And one of the interesting point that the people who come here and discuss this fund with us have made is that the practices of ACE Cash Express would not be legal in Montana because of the limit on interest that we enacted. It's hard to think of too many similar situations where people's business practices, other places, would be perfectly legal, but not legal here.
So, the example I heard was companies that market marijuana in other states.
Right. I mean,
There are some, I think,
right. I don't know.
examples.
I mean, I don't know that it's a, I don't know if there's a question there, it's just, it's a very interesting point that they make.
Well, again, I'll just go back to the comments I made earlier, and maybe I'll take it a step further. I mean, we're acutely aware of our reputation.
Right.
We spend our life in a fishbowl. We're in a very coveted position that, you know, I and the team will want to protect.
And so in Mark's example, you wouldn't be looking for a private equity manager in the marijuana space.
The answer to that is categorically no. But to take it a step further, we have begun, so, you know, you're way off base here, but I'll just take it there anyway. You know, a lot of these folks that are in this business rent industrial property buildings across the US, right? And so when we're talking to prospective and even current real estate managers, that is a question we're asking them. Are any of your current tenants, you know, growing marijuana? Would you rent to someone who is going to engage in this space? And across the board, to date, everyone says absolutely not. That is a slippery slope. You know, it's still federally outlawed. There's state-specific regulations. It's hard to, you know, meld those two together, and so it's something we're very much
But the
aware of.
example given to me was Canada. So there'd be a company that had a subsidiary in Canada that's marketing marijuana, which would be perfectly legal there, but not legal here federally or state. And that's a possibility.
I would say it's remote, Mark. I would say it's very remote. We certainly are not looking for that exposure.
Thank you, Lee.
Certainly.
One more question. I think the person who came in and testified publicly had identified two companies that had kind of run afoul of consumer protection laws, and we focused on the one, but is the other company in Fund 7, or is that?
It is not. We do not have exposure to that fund.
Okay, it was an investment of theirs, it might have been in
I
some
believe
other
it was
fund.
in Fund 4.
Okay, thank you.
You're welcome.
Any further on that?
Okay. Thanks for all the questions. I certainly appreciate it. It's a nice change of pace. We're back on page 21. Here we are. This is our performance sheet for private equity. Here we state the inception to date IRR and the fiscal year time-weighted return. If there are no particular questions here, we'll just continue on to page 22. Total market value as of 6/30, $1.2 billion. It's largely a North American-centric portfolio, buyout focused. There's an increasing focus on direct lending and Asia, as was acutely apparent during the team's earlier presentation on recent commitments. During the quarter, we had negative cash flow. During the fiscal year, we had positive cash flow. We had 4 new commitments to private equity, which we discussed earlier. And during the fiscal year, we had 10 new commitments, $430 million. If there are no questions on private equity, we can transition right into real estate on page 23. So again, keeping it high level, happy to answer any questions. Volumes remain high and stable. Pricing continues to appreciate, but it's moderating. Fundamentals are strong. Supply and demand remains in check, which has been a testament to continued income growth. Capital continues to flow into the country from outside. There's continued interest in broadening the scope of investment beyond just primary gateway cities into secondary markets. A lot of that's driven by yield-hungry investors. And just, you know, probably being priced out of the markets in primary and gateway cities. Pricing has been very high. Cap rates are very low and competition is fierce. a lot of sovereign wealth funds, core funds, clamoring over assets. A lot of assets aren't coming to market. Those are oftentimes very long-term holds, trophy assets. Fundraising has slowed a bit, but again, I think that's just a point in time. It's still quite strong. Dry powder in the space remains very high. I'd say the expectation going forward is that there will be limited capital appreciation, and the focus will be on continued income growth. But as I look at the market, it's not a reason to pull back. It's a reason to just stay focused, be aware, and focus on those managers that have stayed healthy, consistent track records, folks that have been around a while and have performed consistently through cycles. And Angelo Gordon, the fund that Emily spoke about earlier, is a testament to that, and why we committed to that. Any questions? We'll move on to page 25, where we have real estate performance. Both the net IRR since inception and the time-weighted return for the fiscal year and others. I won't walk you through them. If there are any questions, they're happy to address. Otherwise, we'll continue on to page 26.
So the chart at the bottom right on page 25 shows the relative to benchmark for 1 year we did we're 4% above. Is that what that shows?
That's correct.
Okay.
Page 26, net asset value of $808 million as of 6/30. Again, it's a North American-centric portfolio. It's broadly diversified within North America across property types. As we have noted, we continue to focus a bit more on the operator space. These tend to be managers that are property type specific, perhaps regionally focused, or vertically integrated from the disposition, acquisition, property asset management function, construction, engineering, etc. There will always be a space in our portfolio for the investor allocators. So that's just worth highlighting.
What do you mean by investor allocators?
So Angelo Gordon's a good example. Angelo Gordon would partner with an operator, a local operator. They would provide 60 to 70 to 95% of the equity. The local operator would put up their requirement, whatever it is, to get to 100%. They would more or less provide the equity. They would provide, general asset management, budget, business plans, leasing assumptions, etc. The day-to-day oversight of the property would rest with the actual operator that they joint venture with.
Not Andy.
I'm sorry?
And not Andy, just a local person.
Correct. The cash flow profiles here is positive for the quarter, positive for the fiscal year. 2 new commitments, as we discussed earlier, during the quarter. I apologize, I recalculated the math. For fiscal year 18, total commitments was $290 million, not $310. Number of commitments remain the same. Total leverage, 45.5, core 15.7, non-core 58.3. All are within our stated constraints within the investment policy statement. Questions? Okay, let's keep going through natural resources. Pacific Northwest continues to be very strong. Quite a bit of domestic and export demand feeding into that. Lumber prices are high. Consumption remains elevated. Performance is expected to pick up as construction spending remains strong. While housing starts did drop off, I would argue that they remain at sort of historic levels and of no major concern. Questions on, and then I think I've laid out some returns here for the NCREIF Timberland Index. No questions, we'll move to oil, energy, natural resources. Again, the M&A market dropped off a bit, which was a little bit surprising given where the price of oil has moved. I think from the beginning of the year to where we are today, it was a 31% move, which is pretty substantial, and as we'll note later on in performance, a large part of the reason why we underperformed. There's some other reasons for that we can discuss if you'd like. I'll probably point them out anyhow. There's always risk in the oil markets. As we know, there's lots of oil around the world. It exists in places that are volatile and suffer from unrest at times. So, that 6 or 3 standard deviation event can always manifest, and it's something to be aware of. But, long term, this is a place where I think we will generally always tend to be. The U.S. continues to grow its production and will likely at some point be the world's largest producer of oil. Fundraising slowed, but it continues to be dominated by energy funds. I'm happy to address any questions, otherwise we can move to performance. And then we'll go to page 29. We have our since inception IRRs for energy and the timber portfolio and the fiscal year return for the overall natural resources portfolio. Part of what's driving the underperformance here is the index we're in is about 70% oil and gas. Oil and gas has had a tremendous run. The other 30% is in basic materials, things like lumber, steel, that sort of thing. Many of the funds that are in the current energy portfolio and even one that's in the timber portfolio are relatively recent investments and are still quite well within the J-curve. So the combination of those two have really contributed to the difference you're seeing here. Not a concern, something worth noting, just because it's a clear question, I would guess. Are there any other questions about that? Okay. So we'll finish up here. Total market value across the natural resources portfolio, $268 million. Got energy and timber broken out there. Again, both are North American centric. They're broadly diversified regionally. Energies across the value chain. It's not just upstream exploration and production focused, but all the way to downstream storage, transportation, etc. Timber is diversified across the U.S., across species, across age class. Going forward, given a recent commitment to Denham International Power Fund, you can expect to see international exposure continue to grow on the energy side. We will be looking at potentially adding another operator in the space, perhaps debt strategies similar to private equity, where we would lend to either perhaps mining companies or folks that finance mining companies or energy. We are in the latter stages of potentially adding a publicly traded master limited partnership strategy, which we've touched on in the past. So those are just setting the stage of expectations going forward. Cash flow profiles here. No new commitments in the recent quarter. There were 5 new commitments over the fiscal year. Timber leverage is at 6%, which is well within the 0 to 30 overall leverage constraint, as dictated by the IPS. That concludes my remarks. Happy to address any questions. Thanks very much.
Thank you.
Appreciate it.
Let's see.
Chairman, members of the board, I am on slide 31, internal managed fixed income. So as RBK mentioned yesterday, the Treasury curve has been flattening throughout the year. We've talked about that a number of times over the last several board meetings. The Fed has been raising interest rates as well. Market's currently expecting them to raise rates again. Probability currently is about 90% that they're going to do it in September, and maybe a little better than 50% that they'll do it again in December at this point. Inflation's been picking up a little bit. Actually got core CPI up to about 2.4% in July, so a little bit above maybe what the Fed would consider their target, I guess. They probably look at some other metrics as well, but kind of getting there. Spreads across the board throughout the course of the fiscal year, as Joe kind of mentioned, have been reasonably tight within the space, whether we're talking agencies, corporates, or mortgages. So we've been a little bit more cautious there. In terms of performance, as Dan pointed out earlier, pretty low returns within fixed income over the course of the fiscal year. We're glad to hear him say that we're still important. Provide a lot of returns, so that gave us some comfort. Bond market liquidity and investment grade issuance has remained strong throughout the course of the fiscal year, so no real hiccups there. Steady as she goes, I would say. As Joe mentioned, the Federal Reserve has begun the process of reducing their balance sheet. They started that in October of last year. They kind of stepped that up a little bit each quarter until we get to the end of this year. And so they're reducing both their treasuries that are on their balance sheet and their mortgages. That forces that into the private side of the market, so it increases supply overall, and investors such as ourselves have to buy that. So some hesitation there that that's going to kind of widen out spreads particularly in the mortgage space. Any questions on the environment? All right, moving to 33, Treasury Agency portfolio. Again, a little bit of a negative return overall in the asset class for the fiscal year. We outperformed that slightly. We've got about $1 billion or so in the Treasury portfolio here. We've been a little bit underweight the long end of the curve and a little bit underweight duration, probably more or less throughout the duration of the fiscal year. Given that flat curve, there's not a whole lot of pickup to go from particular, say, the 7 to the 10-year portion. Currently, it's only about 5 or 6 basis points to go out that additional 3 years. So a little more cautious there. We've been a little over our overall range within agency CMBS and a little below in agencies overall. That's probably been pretty static for the majority of the year.
John, when we say billion overall, that's for all, the whole investment program, that's not just pensions.
That's just pension, that's
just pension, that's just cap.
Yep. Moving on to 34, TIPS portfolio. So this was the best performing portfolio for the fiscal year. You'll remember we did add this as kind of a new asset class when Joe came in, and was kind of scaled that up over the last 2 years or so. So that's definitely been beneficial to us this particular year. We're not particularly active in this portfolio at this time. We generally just kind of rebalance to model the characteristics of the index once a month as the index rolls over. So not a big active weight here at this point in time, partly because we just don't see that opportunity right now. We did increase our allocation a little bit here during the course of the fiscal year. I think we added about $50 million overall, but other than that, not much else to say on TIPS. Questions on that portfolio? All right, the mortgage portfolio did eke out a positive return in the asset class for the year. We managed to outperform that a little bit here as well. We decreased our allocation just slightly, but it's about $25 million, I think, in the fiscal year, probably more towards the beginning of the fiscal year. But as Joe noted, it's more that probably relative change in terms of it not growing versus equities that caused the differential in the overall portfolio. We've been cautious here again, significantly overweight kind of 20-year mortgages, which Joe talked about earlier. These are residential mortgages typically, so they have the prepayment option, and a homeowner can move or prepay their mortgage as they choose. That affects us a little bit less in the 20-year, and given the shifting interest rates, that should help us outperform and did in this particular year. Again, fairly tight spreads here. Not a lot of opportunity really in the ABS securities, so we haven't been towards the bottom of the range there. We're kind of middle of the range in the non-agency CMBS, which is an area we can own in this portfolio. Questions on the mortgage portfolio? All right, moving to 6, investment grade credit. Again, here is noted, slightly negative total return for the asset class. Managed to outperform a little bit here as well. We did decrease the allocation here because, as Joe noted, just believe that the risk-reward trade-off currently in corporates is not particularly attractive. Generally, throughout the course of the year, spreads have been somewhat below the long-term average, and you'll remember in the first quarter it was significantly that way, and we were kind of probably took money off in say the third and fourth quarter of last year primarily, as we kind of progressively got tighter and tighter. Again, a little bit underweight duration here, a little bit overweight more that 5 to 7 year portion of the curve where we feel like we can pick up a little bit of yield, but still kind of allow spreads to compress as they move, as they shorten up over the course of the years. Overweight financials, but tend to be shorter duration in the financials, and more longer weight industrials, neutral utilities. Still kind of maintaining a higher quality bias, I would say, overall here to somewhat of a cautious stance. Questions on corporate portfolio? All right. Next page 37 just shows the returns, which you've kind of seen a couple of times here before, but happy to answer any additional questions if you have any. I'll do it then. Thank you.
Thanks, John.
Okay, Randy, let's we're going to take a break for a short period of time before you. Let's do 10 after. All right.
Very nice.
After you. Okay, we're back to session. Randy, you're up.
Okay. Hello again. As far as the public future market asset classes go, let's start with broad fixed income on page 38. You recall broad fixed income asset class at this point is exclusively the REIMS fixed income portfolio. That portfolio outperformed by about 90 basis points in the fiscal year. These guys have been defensively positioned for quite a few quarters now, and they've been overweight treasuries and have had an abundance of cash. They did draw their cash balance down a bit from 6% to 3% in the previous quarter, but also increased their treasury weighting a bit in the quarter, so still very defensively positioned. The performance numbers on page 39 for broad fixed income back through several years, you can see relative performance of the benchmark. Any questions on broad fixed income? Okay, seeing none, high yield is next. I won't say a lot about high yield since we did a deep dive yesterday. Spreads are still really tight historically for high yield. As far as our managers as a whole, performance for the asset class in the text there on page 42 and in chart on page 43. The relative returns were below the benchmark by about 120 basis points for the fiscal year. That's to be expected, given, as you heard from Jason yesterday, how we're positioned with 4 managers in it that are all defensively positioned managers with downside protection. So in an up market in high yield, it's likely that they wouldn't outperform. So no concerns there. As far as the positioning goes, we have 4 managers as mentioned yesterday. We recently hired Oaktree and Shankman back in December. There are smallest allocations of $50 million apiece. We're biding our time with them just to get to know them even better than we did when we hired them. It's likely at some point that we would even out the weighting somewhat among the 4 managers, and so they would be a benefit of that. But again, like I said, they've been with us for less than a year, so we're biding our time there. Any questions on high yield? Okay, moving on, domestic equity. Not a lot to add to that either, given the discussion that RBK put forth yesterday. Fundamentals are good within domestic equities. Profits are growing by probably over 20% for this calendar year. So things are strong. The market is, as we speak, trying to challenge the January highs. And a lot of that's coming from not only good earnings reports and guidance that we recently saw in the market, but also some hopes at least that what's been weighing on the markets more than anything is the trade and tariff situation. There's some hopes there that China and the U.S. might get something worked out before the elections. Just a coincidence there. As far as the asset class goes, slight underperformance for the fiscal year of 8 basis points, which is, you can pretty much call that roughly in line. Small caps did really well, so our small cap allocation was added to the returns for the fiscal year. Our active managers as a whole have improved in their performance. Industry-wide, active management has improved somewhat also, but still a challenging environment, I would call it, for active managers as a whole in the domestic space. The market's valued on the S&P 500 index at 16 times forward earnings at this point. And as earnings grow, as they've been growing substantially this year, and the market's held somewhat steady and been in a trading range for most of the last 7-8 months. Like I said, challenging January highs, but still really haven't gone anywhere since that point. But anyway, so the valuation has come down a bit for domestic equities when you look at forward 12 earnings, because earnings went up and the market hasn't gone up in relation to that. So not quite as expensive as they were in January this year. And let's see, page 47 shows the returns. Again, you heard really good, solid double-digit returns for domestic equities for 1, 5, and 10 years. Slight underperformance for those periods on a relative basis for the asset class. But again, given what challenging environments through those years that asset management had as a whole in the industry, pretty good performance on a relative basis, I would say. You always wanted to be green rather than red. But again, our decision to restructure domestic equities about 6 years ago, this past May, and be more largely passive in the large caps I think has really paid off for us. So I'm pretty happy with that. That's led to top quintile performance in both 5 years and 7 years that we talked about yesterday. So like I said, pretty good performance given the environment out there for domestic equities. Any questions on domestic equities? You heard about Voya earlier today. I didn't mention Voya here in this text because this is actually for the quarter. In Voya, we terminated the second week of July, so that would be listed here next board meeting as far as termination in the third quarter. We can talk about it again then if you want to. Let's see. So no questions on domestics. Let's go to international. Fundamentals there in international are pretty good too. The earnings picture looks pretty good, although not as robust as the U.S. The challenges there in international, of course, are trade and tariff issues, stronger dollar issues weighing on emerging markets, and just an overall event risk there that has knocked those stocks down a bit in their performance in relation to the U.S. If you recall yesterday, international stocks earned about half during the fiscal year of what domestic stocks did, but still, 8% isn't bad given all that's going on out there. As far as the relative performance for the fiscal year, international equities outperformed for the fiscal year. A lot of that came also from small cap allocation, because small caps did outperform large caps. Our overweight to EM did help during the calendar year, although we gave quite a bit back as far as the attribution from EM in the fiscal year in the most recently completed quarter, the last quarter of the fiscal year, because emerging markets stocks are down about 8%, which again, that's concerns about tariffs and particularly a stronger dollar. But all in all, pretty good performance for international. Just to reiterate that when we look at peer group performance for international in the RBK book, not as good a comparison of peer group performance as domestics, because we have an ACWI ex-US mandate, which means our managers in our pool, our asset class, includes emerging markets. And a lot of our peers do not have emerging markets to the extent that we do. So that can make those numbers kind of comparing apples and oranges at times. And depending on how emerging markets goes, our relative performance, our peer group performance can be affected by that. I don't know if that made any sense or not, but okay. And let's see, no changes in any money going in and out or any managers being retained or terminated there. No change in our state of managers or international equities during the past quarter.
Mr. Chairman, Randy, I noticed this on page 56, you're looking at an allocation to partial long-short portfolio. We obviously have that in the domestic, this would be the first time you've had it in international.
Yes, yeah, I'm glad you brought that up because I did want to mention that. In fact, Jason and Steve are going to go visit one of the managers that we're very interested in Boston here next week, and that would be our first entry into the 130-30 space, the partial long-short space, and international.
Why?
Why?
Why are we looking at that?
Well, because for one, we've had such good success with that in domestics and adding value that we're interested in doing that in international. And we believe that, although the international markets are, more efficient than they used to be, they're still not quite as efficient as the U.S. markets. And so a partial long-short portfolio in that space, could benefit us. Did that answer your question? Or you're not nodding, you're like, okay? Okay.
Follow-up question. Is that, are international managers slower to embrace that investment style than domestic U.S.?
Yeah, that's a good question. It's not as, the 130-30 partial long-short type of portfolios are not as prevalent, they're not popular in international.
I've never heard of that.
And yeah, when we sent Jason on to do this due diligence, we kind of knew that, but there are a couple that we've identified that have been doing this type of portfolio for quite a few years and have been pretty successful at, very successful.
Well, not every country lets you short. Does France let you short?
The developed countries, you're able to short. The emerging markets, not so much. Most of the emerging markets, they're not developed to where you can do shorting.
The mechanics of this are going to be a little different than America.
What kind of premium do we pay for a 130-30 manager over a traditional long manager?
In fees?
Yeah.
In large cap, which these are, we typically pay about 65 basis points, 60 to 65 basis points for a domestic 130-30 manager, and the domestic long-only large cap managers are about probably 35 to 50.
Okay.
A little bit more expensive. 133 is a little bit more expensive than international, but they're north of 65 basis points. But the large cap long onlys in international are 35 to 50, somewhere in there. Yeah, and the reason we are willing to do that is because we're not just saying, hey, gee, we like you guys so much, but give you an extra 15 basis points. We think with that shorting capability that they have a better chance to beat the benchmark. Therefore, our bar for them is, as far as relative performance, is higher for them. We expect them to do better than a long-only portfolio.
Our expectation, but our benchmark doesn't have a question mark. We don't have a built-in
Like a long-short benchmark, correct.
Right.
Yeah.
Okay.
So remind me, Randy, I just looked it up in the glossary, but the 130-30 says 130% long and 30% short, which is 160%. I don't understand. You remind me how that
Don't
works.
you subtract the sector.
There's actually the way the portfolio is structured and the way the mechanics work. You have what they call an extension piece. So you have your like portfolio, which is 100%. And then the way you mix together your borrowing and your shorting, you end up with an extension piece that has 30% more longs than the long-only portion of the portfolio, and it's matched off by 30% shorts.
Okay.
So together, those cancel each other out.
Oh, okay, so that makes sense, thanks.
And that's all I have, unless there's any more questions. Okay, we're good.
Thank you.
I'd like to ask Yvette, do you like this idea of a 130 in international?
Well, conceptually, I recall several years ago, this is something that we talked to staff about and introduced as an idea in domestic equity. There's no reason why it shouldn't work as well philosophically in international equity as long as there's enough markets to short. Now, obviously, not having the emerging markets develop to the point where you have a true representation there of the whole equity, ex-US, to short, we don't think is enough of a barrier not to consider it at this point. But it's going to be something interesting to watch with this manager on site to see if they can prove that they're adding value through their shorting. You know, because the whole philosophy is a manager on the long side's looking to find stocks that are going to have appreciating prices over time, and the 30% or 40%, whatever the particular product is looking at. On the short side, you're allowing the manager to represent an opinion about stocks that they think will go down, whereas a traditional long manager just wouldn't hold those stocks. So in theory, if they can make money on the downside, there should be extra alpha there overall versus the benchmark. But it'll be interesting to watch. We're aware in other client portfolios of a few that have followed that international partial long short, but it's a newer strategy to consider.
I would just add, it's, conceptually, it doesn't seem to be that, with the exception of emerging markets, it doesn't seem that much different than domestic equity, but it's very manager specific. There are going to be managers that fail at this. Shorting can be more tricky than going long. So it really comes down to manager selection, which, there is some precedent for picking some successful managers in this category of the domestic equity, but, it's kind of thing that it really comes down to manager selection.
Thank you, Mr. Chairman. I'd like to go over STIP starting on page 57. I'd like to be brief, but not so brief as to offer offense to the board, so ask any questions you would like. The theme...
We're hard to offend.
Jack in particular.
So theme of the environment, again, is continued increases of the Fed, and we expect one or two more this year and a couple probably next year, so we would expect the yield of STIP to continue to rise. In terms of performance, just a slight underperformance as you would expect in a rising interest rate environment. The characteristics largely unchanged year over year. There was about a $300 million increase in the assets of STIP, partially from increased contributions from local governments. Also, STIP being the beneficiary of asset reallocations as the domestic equity outperformed. We get a little taste of that as Joe reallocates assets. And then a increase in state finances from what was a very low period at the end of the prior year. The reserve was up about $8 million year over year and continues to increase towards the target of 1.15% of the assets of STIP. And other than that, I would be happy to answer any questions.
All right, I will continue with state fund then. Solid performance in state fund over really every time frame. A little bit of positive outperformance driven by our overweight to spread product, a little bit of a tips allocation in some of our duration positioning. Similar to maybe the cap fund, no real significant change to equity weights over the course of the fiscal year, although you'll recall we did reduce a couple of times in, I believe it was December and January, but given the run we had in equities year over year, probably not running in place. Similar to the other portfolios, a little underweight overall duration and kind of maintaining our the quality bias there within our spread product areas. Answer any questions on state fund? Seeing none, I will go to slide 61 then, for trust fund. Similarly, good performance over all the time frames here. Similar positioning really to our other portfolios, not a lot to add to that, I don't think. Maintaining again our overweight to spread products and things. We do have, this is a longer portfolio benchmark here, so it's the ag. We go out to 30 years and would note that we are significantly underweight the long end of the curve being the 30-year because of the aforementioned very flat yield curve. Don't feel like there's a lot of value in going out long at this point in time. I can answer any questions on trust fund as well.
Thank you, gentlemen. No offense taken. We're to real estate west, asset. Right? Yes.
Mr. Chairman, if I can ask, we would like to use the screen today to show a presentation. So if we could have staff members please move shift chairs either that way or right here so everyone can see the
David had her sign
Okay.
I should have brought some of that folders. Oh, yeah.
All I had was 2 piece gears on
Boy, they were only $5, man.
Yeah. It was chili, right?
Yeah. Oh, there it is.
I could tell it was like
You can all see it's a two-part authentication. She's got to put in her RSA code, and then she puts in her password.
All right, can everyone see? Our apologies for having our backs to a few of you. Welcome. Good morning again, Chairman, members of the board. I'm Emily Kovar, an investment analyst on the private investments team. And today, Terry Colnick, my colleague and fellow analyst, and I will be presenting to you an overview of our real estate asset class. During our time together today, we will discuss concepts of real estate investing, our plans and data points for Montana's real estate asset class, our view of the real estate market, and take a worldwide view of our new property acquisitions of the past year, and zoom in to do a tour of a sample of specific assets that Montana has ownership of. You'll notice that certain words are highlighted in the presentation, and these words are terms that are defined in the glossary that's at the back of each of your board books. At the end of each portion of our presentation, Terry and I will cover, will allow time for questions, but feel free to ask any questions throughout the presentation.
How will you see if I have a question?
You might be able to answer this question.
Oh, yeah.
I'll do it. All right. So to start out, just want to cover the big points of our real estate asset class and what its role is within the Consolidated Asset Pension Plan, or CAP as we refer to it. The real estate asset class is meant to give exposure to diversified real estate opportunities in a prudent manner, looking for the possible highest return. We strive to diversify across types of real estate investing, have a myriad of number of funds across vintage years and across real estate types, referring to office, retail, hotels and such, and as well across geographies throughout the U.S. and the world. We work through, in accordance with the investment policy statement, and abide by the approved ranges that have been set by the board, keeping real estate within a 4 to 12% of CAP. We aim for all of our core real estate to be 30 up to 100% of our asset class. Non-core is to be 0 to 70% of the asset class. And as you can see, some other metrics here that we work and actively monitor and stay within. Noting the leverage limits, you'll see that our core leverage is to be between 0 and 50 and non-core at 0 to 75. And as Ethan highlighted a bit earlier in the presentation today, our portfolio is within those limits. The benchmark that we've been using since April of 2017 is the MSCI US REIT Index. The types of real estate investing that we're doing include a view of it that can be done as looking at a quadrant. So there's public and private real estate investing, and you can do so within an equity or a debt structure. Currently, within public equity, we do have a Vanguard real estate ETF. As of 6/30, this was 4% of our real estate asset class at almost $36 million. This is where you have pooled capital from investors that purchase real property directly and are publicly traded. That is our public exposure in real estate. The majority of where our holdings are within private equity and limited partnerships within open or closed funds. Currently, our asset class is 90% in private equity, these private type funds. And these are, of course, as you know, typically organized as limited partnerships. They invest in the real estate and they're managed by private investment management firms. In the public sphere, which is quadrant C there, these are real estate, public debt items. And as Terry discussed with you earlier today, we've just recently made our first commitment in this space, $20 million to the Fidelity Real Estate High Income Fund. And so what we're looking at there is that, as Terry described, is a fund that invests in publicly traded real estate securities. This allows us to continue to diversify our real estate asset class. Then in quadrant D, private debt. These are funds where they are lending capital to the owner or the purchaser of the real estate. We are currently in the market looking for real estate debt funds, but we have not made any commitments so far. And the remaining splits of our real estate asset class include 2% of direct ownership, which are the properties that were discussed yesterday that Montana owns, and we do have 3% of 630. Next is we wanted to talk to you about the styles of real estate investing. This is an interesting building. This is actually a building that Montana has partial ownership in through our Angela Gordon, one of our Angela Gordon funds. And as you look at the outside of the building, it looks the same. But what makes the style of real estate investment, what makes it unique is the underlying characteristics of these assets. So the industry standard way of organizing commercial real estate is to look at it through styles of real estate investing. This refers to the categorization of the real estate managers based on the risks and reward expectations of their investing. And is in trying to put it into these three avenues, it helps to organize and evaluate the real estate opportunities for those managers. So as you can see here from the outside, the property can look the same. And this property is actually in downtown Chicago, stunning property. But the question remains, is it a core value add or opportunistic property? And that just, as mentioned, that depends on the characteristics of the property. First, let's talk about core properties. In core properties, they have low volatility. Investors can own equity or debt. They typically have high occupancy rates. They're the least leveraged, most liquid. There's numerous buyers and sellers for these types of assets. And most importantly, the investment return is mostly from rental cash flows and not appreciation. In the center, these are value-added properties. Value-add as well, the investors can own the equity or debt. But in value-add properties, there's a mid-range of occupancy rates. There's a bit more use of leverage that's moderate, but more than core. And these types of assets generally need operating improvements and perhaps a reduction of expenses to help them be more profitable. You might need some minor renovations. And for a value-add property, the investment return is more from appreciation than rental cash flows. And lastly, on the right, the opportunistic properties. Again, investors can own equity or debt. These properties typically, though, have lower occupancy rates. There's higher use of leverage, and that's because these assets typically need major operating improvements, including change of use. So when we have opportunistic managers who are investing in this type of real estate, what they're trying to do is pursuing actions that will result in the real estate to begin to quickly and dramatically revalue, because they're striving to achieve the investment return nearly all from appreciation. Any questions so far?
Hi, I'm Terry Polnick, and I'm going to start on page 6 talking about strategies of real estate investing. In the past, we invested in allocators who provide diversification in product types and geographical location throughout the U.S. But in the last year, we have been focusing on adding operators. These are vertically integrated managers who have internal operations staff. A couple of those we committed to are focused on a single property type. They are Bell Partners in multifamily apartments and BKM in multi-tenant light industrial. On page 7, There are two sources of real estate returns, appreciation and income. Appreciation is positively affected by some of the drivers listed in the right-hand column. These drivers include strong demand, superior location, high-quality physical condition, and an abundance of on-site and nearby amenities. Appreciation can be increased further by increases in nearby comparative properties and by capital expenditure improvements. Examples would be parking lot improvements, window replacements, and replacing old heating and cooling systems with more energy efficient ones to reduce utility costs for tenants. Our second source of return is income. Income is positively affected by these drivers. Increased occupancy, which can be achieved through square footage gains, through remodeling or additions. It can be increased through occupancy gains, which can be achieved through right sizing of space for tenants. For instance, in retail, you can divide a large space and rent it to 2 tenants for a higher combined rent. Or in office, you can use shared working space and have multiple tenants as well. Income gains can also be achieved by raising rents. Rents can be increased through offering more appealing amenities, such as in multifamily, you can offer a laundry room, gym, indoor and outdoor gathering areas, while in office, ground floor retail can be occupied by popular restaurants and shopping. Tenants also highly value 24/7 building security. When contracts are renewed, you can bring rents up to market levels. You can modernize space to make it more appealing and increased energy efficiency, like I mentioned earlier. A good asset manager will be able to balance the cost of amenities and services offered to tenants against how much he can increase rents to cover them and still produce growth in the net operating income, or NOI. I'd like to cover the benefits of real estate investing on page 8. Our real estate program looks for investments that will be resilient to market cycles and not substantially affected by public markets. This enhances the level and consistency of our returns. We invest in real estate because this asset class's returns have relatively low correlations with traditional investments such as stocks and bonds. The diversification value of real estate helps us maintain our overall portfolio returns while decreasing volatility risk. Tenant leases often contain provisions for rent increases to be indexed to inflation. In other cases, rental rates are increased when the lease term expires and the contract is renewed. Either way, real estate income tends to increase faster in inflationary environments, allowing an investor to maintain its real returns, which is nominal returns minus the inflation rate. Contractual income helps ensure this outcome. An investor can increase the value of real estate and improve its performance by improving the interior and exterior, and thereby attracting higher quality and higher rent tenants. Real estate investing is not without risk. We have business risk, which is the risk of loss due to general market condition changes. Financial risk, which involves the type and level of debt used. Liquidity risk, which is the inability to sell a property when you want to at a competitive price. Inflation risk, which is the risk that the real value of properties and contracted income could decrease due to unanticipated inflation. Operational risk, this relates to an investor's dependence on effective management of properties to maintain occupancy. And finally, legal risk, which involves securing and maintaining claims to the property. Do any of you have questions about the information I just covered? All right, thank you.
Next, we want to talk about our pacing. Pacing is how we plan to invest capital across years to maintain our real estate allocation within the approved ranges. The things that we consider about this are, how are the capital calls and distributions contributing to maintaining that allocation? And in light of that, what are going to be the anticipated timing of those distributions and those commitments? We work closely with and use data and studies provided by RBK. They look and evaluate our current private real estate exposure relative to the total plan assets. They take into account the annualized growth rates of those assets, looking at paid-in capital, distributed capital, valuations, and looking at giving us some scenarios to provide some flexibility to explore ways that we might want to deploy the capital in the coming years. Starting in 2017, we focused on increasing our core real estate exposure. And non-core pacing has been set based on our pacing analysis to be a $120 million target annual goal of how much we would like to deploy, considering the right opportunities if we do find them. And this would translate into an expected number of 4 funds per year with an approximate commitment size of $30 million. To give you an idea of how we think about and move through our activities of real estate, I think it's very helpful to see what our deal flow has been in the last 5 years. The funds sourced and reviewed were over 1,400. During those initial screenings, we killed nearly 1,300 of those funds. And then moving forward, the funds out of that advanced into an initial stage of due diligence were just 55. Moving from that to state of final due diligence, we moved 32 funds forward in the past 5 years, and in the end, just committing to 27 funds. This 27 funds of the 1,418 deals reviewed means that we have a 2% commitment rate. This is how we have committed our real estate dollars in the past 5 years. 2013, 40 million to core, 75 to non-core. 2014, it was non-core at 80 million. 2015, 95 million. 16 was 70 million. And you'll see in 17, we were quite active in the real estate space with $220 million committed to core real estate managers and $225 million committed to non-core for a total commitments of $445 million in 2017. Going forward, what we're looking at is in 2018 an additional $60 million into core with $120 million annually, as discussed previous in our pacing analysis, $120 million each year going forward.
So why the spike says in the 18? Is that market timing or is that
the opportunity set that was there, as well as our general thoughts on the timing of the cycle and wanting to invest with managers that we thought were going to bring accretive benefits to the portfolio overall.
So when you look at you look at that page, do you assume going forward that that's sort of the pattern, and it's stable for a number of years and then a year or two where it spikes?
I think it's more likely that you'll see greater bumpiness in these 120 million commitments. And that partly has to do with doing the due diligence late in the year, but the commitment might actually come early in the year. And part of the spike that we saw was our decision to invest in operators, funds that had operators in them, and just the opportunity and the timing of their fundraising. So we expect bumpiness. This is not a boundary. This is just a projection, and it will average out that way, but it's definitely not precision.
So the reason that you
anticipate no core real estate investments that you've made quite a few core real estate investments recently? Balance things out, or is it because you have funds for managers that you like better that are doing non-core, what combination?
So this blue is one of the funds that we actually committed to in this third quarter of last year, but they have such strong demand that they couldn't actually call our capital until this year. And so this was a known commitment that will actually be called. We also will not stop looking at core. It's just that there's been nothing planned, but we're continuing to look at core, and it could be additive to this non-core exposure.
Okay. But Mark's question is nothing planned because you think we're at a good limit for core, even though if you find something good, you go above it, or is it because you have more confidence that we can do better with non-core?
No, it's more the former. It's more the former.
Right.
We're continuing to look at core, and what we did previously in the large spike you saw in 2017 was a result of a wide survey of the ODCE funds, trying to reevaluate our whole portfolio. And so we added a couple managers, we subtracted one that we talked about earlier. I think there is potential for possibly another one, but we kind of have a limit on how much we want there. And since core funds allow redemptions, if we saw something we really liked, we might pull back on a couple of the others and then add another one. It wouldn't do a significant increase to this 120, but there might be some rebalancing going on.
Terry, if I could, one core choice words. An important thing to understand is, yes, we're comfortable with the current allocation to core, and so not looking to meaningfully change that at this time, but that can always change. But the key thing to understand with non-core is that these are the assets we make commitments to. They draw down over time and they pay distributions over time. So we're always needing to replenish the non-core just to stay where we are. In the core, they're distributing income, but not over time, typically distributing our principal component of it, and therefore that exposure is more maintained, so there's less of a need on a regular basis to continue to invest in core. And so that's the reason it looks this way, that we're putting most of the dollars in non-core, but in reality, we're looking to keep the balance between core and non-core relatively in line with today's economy.
Next, just want to highlight the performance market value of the real estate asset class. As previously presented, our time-weighted returns as of the end of June for the fiscal year were 7.61. This did outperform the benchmark by 4% that was previously noted. And as a percentage of the overall cap, we're just north of 7% with a market value of $808 million.
So a question related to yesterday. I'm just kind of looking ahead to the pie chart about the Montana-owned offices. I assume those are the ones we discussed yesterday. Is there any way to break out those properties and say what percentage of this is from them?
Actually, yes. So in the very back of our presentation in the appendix, you'll see that we've given you this would be on page 38, I believe. So overall, real estate asset class, the inception to date IRR is 6.35. Our core properties have contributed 6.25. The Montana office properties portfolio have contributed 6.16, and our non-core funds have contributed 6.42. And altogether, that blends to the 6.35 IRR since inception.
Thank you.
Next, just want to talk a bit about the market value as
Jeff, may I just interrupt briefly? So I think to answer your question specifically, I believe the market value of the Montana Health properties was just north of 19 million. And if I do the math, that brings as a total percentage of the portfolio, it's just north of 2% overall. And I believe that was your question.
Partly, but also the actual returns here, so you can see that only 3% of the income is from that, but they are actually a little less than the IRRs on the other two, which is kind of what I wanted.
Gotcha, sorry.
And several of those properties clearly are nothing for us other than ground.
Yeah, and as Ethan alluded to, as we look at the asset class by strategy, our core position, our core funds are 44% of the asset class, non-core 53%. Non-core, of course, is comprised of the value-added funds as well as the opportunistic funds. And then the Montana office properties, as we were just discussing, are 3% of the overall asset class. A couple of depictions of our asset class by geography. We are 98% invested in the United States, with smaller portions in foreign countries, United Kingdom being the most, Canada, just 0.18% up in Canada, South Korea, 0.14, and the rest of the world just at 0.77. In looking at where we're focused within the U.S., our portfolio is well diversified across all of the states. You'll note that our exposure to California and Texas tend to be two of our largest concentrations. And then there's a U.S. diversified portion. This reflects properties that managers have bought. For example, perhaps it's a group of office buildings that might be placed over a couple of different states, and they buy them from one manager. So then as they name that portfolio, those locations are diversified and not just particular to one state. So that's where the 14% comes from. Oh, yes.
This is a really dumb question, but we just established that the Montana office properties are 3% of the portfolio, but it's only showing 1.44 by geography.
Terry, that refers to a fund of funds investment with Landmark, and there is a Montana property within that fund of funds.
But I'm confused because the Montana specific ones are 3%.
You know, that's a good point.
Maybe they're not in that.
I don't think that they're in there.
Okay.
So that would be in addition to the...
Okay.
Yeah. Good question, thank you. Within our strategy in investing with real estate, we do strive to have a diversification across property types, and we're most heavy in office at 41%, in apartments and retail, 23 and 14% respectively. Industrials, 12% of our portfolio, and it's rounded out by some mixed-use hotel, self-storage, and parking, a little bit of land in there as well. This slide shows the market value of our non-core portfolio, just split out by the vintage year of when the real estate fund began. So what we're showing here is that you can see from our older vintage funds from 2006, when we very first started the asset class, through 2012, these have lower market values because these funds are winding down and selling those fund assets. Funds launched between 2013 to 2015 are nearing full investment. You'll see that that's where a lot of the market value of our asset class resides for non-core. And then newer funds that began since 2016 They're still early in their investing period, and the market values will build as these funds become fully invested. Here we want to highlight to you who some of our top managers are by market value. Within core real estate, we currently have 5 managers that we have outstanding market value with. JP Morgan, Prudential, UBS, American Realty Advisors, and TIAA CREF. That is an asset that is winding down, and we'll be redeploying that capital. Our top non-core real estate managers, biggest holding is with DRA currently in accordance with market value at $54 million. Going down through the list here, down to Realty Associates at $16 million. But you can see that the market value amongst our non-core is well diversified amongst managers, and indeed we have a large pool of non-core managers, but these are our highest value holdings at the time.
And we don't have managers that manage both core and non-core.
That is correct.
And is that because they don't exist, or we don't have confidence that someone can do both, or?
They exist. We have confidence they can do both. Many of these core managers do both and have done so successfully. We've just, based on the opportunities, gone elsewhere.
All right, I'd like to talk about the real estate market environment. On page 24, I will also discuss how the private investments team is planning to respond to the market environment. Appreciation returns have been very strong since the Great Recession, but they have slowed to 1% over the past 12 months. However, there's wide variation among property types. Industrial leads appreciation growth with a 12% increase as demand is outstripping supply. Multifamily appreciation growth has been fairly strong still at 4%. Office appreciation is flat and facing headwinds from new supply coming online. Retail has been flat overall, but malls and strip retail have depreciated 9% and 3% respectively. Non-traditional real estate has appreciated overall during the last 12 months, led by manufactured home parks and student housing, both at 10% appreciation, hospitality and lodging at 5%, self-storage at 3%, and healthcare facilities at 2%. On page 25, industrial real estate is leading income returns as well. E-commerce trends have led to increased demand for industrial properties. While big box industrial located near major ports are still important, growth has been focused more on last mile industrial for deliveries of goods. In multifamily, although growth in demand for urban multifamily has been generally satisfied with new supply, demand has shifted to less expensive options just outside of urban centers. In office, net operating income is growing in certain submarkets due in part to high employment levels. That growth is highest at buildings with shared workspaces, open floor plans, locations near public transportation options, and those with nearby amenities like restaurants and shopping. Retail is a case of winners and losers. In the loser column, B and C malls, whose tenants are seeing declining sales, store closures, and bankruptcies. These tenants are like Penny's, Sears, Kmart, and Toys R Us. Also, big box center tenants are vulnerable to these trends as well. Income growth has shown improvement in retail assets which add experiential tenants like movie theaters, restaurants, gyms, and medical. These are less affected by e-commerce trends. In some retail assets, they have actually converted vacated stores to shared office space. Another winner is tenants who pair bricks and sticks retail with e-commerce. These are more resilient since they can offer tangible displays of merchandise and pickup and returns of items ordered online. On page 26, high occupancy and rent growth have been driving growth in net income returns in all property types since 2010. It's just been a really good environment for real estate overall. Based on our assessment of market conditions currently, we continue to favor North American real estate. We're also focusing on the benefits of investing in real estate operators. They are on the ground with assets frequently, leading the strategy for maintenance, capital expenditures, and leasing. We continue to have interest in core real estate funds. These funds invest in stable properties that produce consistent net income returns for our portfolio. Our private investments team is also looking at numerous real estate debt strategies and managers because these funds provide regular income from debt payments, and debt is at a higher level in the capital structure than equity, which reduces risk. Finally, we're continuing to look at publicly listed real estate, such as REITs, which may provide beneficial returns and diversification for our portfolio. I'll pause for a moment to take any questions on our strategy and rationale. Okay.
All right, at this time, this is the fun part of our presentation. We're going to do a little zooming in across the globe, looking at a few of our properties. Just give me a moment while I pull this up. So first, United States. First, we want to take a look at all the new properties that have been added within the last year. As you can see across, and I'll try to zoom in here a little bit, different colored pins on the map indicate different types of assets. Green is our office properties that were added in the last year. Blues are hotels, residentials are orange, reds are industrial, yellows are other, not many of those. As you can see, is on the East Coast, several different properties there, down across the South, managers adding properties in the last year, several on the West Coast, and even on a more global view. Let's see if I can turn our map here, not make anyone dizzy.
Yeah, it's getting
He's so easy, like, plan on it.
That is not.
Yes, you have to go for yourself.
We did have a few properties added in the Asia area, right here, thank you. And these were primarily through our assets with Angela Gordon and her past funds. They are doing some international investment. Now we'll target some specific assets.
Nothing in North Dakota and nothing in North Korea. I'm shocked.
So as we looked at that prior slide, that pretty building in Chicago, we're going to take a little tour of that building. This is located at 131 South Dearborn Street. This is near the Loop of Chicago. This is the street view of the property. This is a trophy building that was constructed in 2003. Angela Gordon purchased this building in July 2016. Has a view of Lake Michigan, which I'll show you here in a moment. This asset was purchased at 60% of replacement costs. Plans that Angela Gordon has for the building are to inject new equity into the property, which will be used to fund capital that's required for new tenants and to build out highly amenitized common areas. There's 1.5 million square feet in this office tower. They've executed leases with anchor tenants such as Citadel and most recently Convene. And Convene is a premium meeting and event space company. They are now 88% leased, and they've completed 750 square feet of new and renewal leasing over just their 2 years of ownership. They've begun doing lobby updates and renovations, and they are actively marketing the street level retail that is going to be offered down here, further adding value to the building. And as we exit that street view, I just want to show you the great views it has just right there of Lake Michigan. You see the loop here in Chicago. I'm sure those higher floors have a wonderful view out across the city there, making it a key and accessible area for people to want to have their offices in. This is a value-add property because the targeted actions that Angela Gordon is taking is to lease it up and renovate it. Next, we're going to take a look at one of BKM Capital Partners' multi-tenant light industrial assets. Market conditions for light industrial are very favorable right now, and we're happy to be invested with BKM as they've been actively deploying the capital in the fund that we are a part of. This is a 161,000 square foot multi-tenant industrial park that is in the premier Miramar submarket of San Diego. It's 5 buildings. They bought it for below peak pricing, and their interest in this asset is that there's a paradigm shift that's going towards the high density uses, and this asset is very well situated with exposure and easy access to the interstate. I need to go up just a little bit more here. You'll see a primary thoroughfare here and the interstate right here. This helps with them meeting the logistics needs of companies that are trying to satisfy e-commerce demand, and makes this location very, very appealing. The property was 93% leased at the beginning of the quarter. They finished in the end of this quarter already increasing lease occupancy at 94.3%. They are actively improving the asset. They're painting it, doing landscape, outdoor seating, signage, and asphalt, and recovering in the parking lots. And they expect to have all of the renovations completed in Q3 of this year, and will continue to fully lease out the asset. Any questions? Right. Now Terry's got the gem we'll take a look at here.
All right, I'm going to show you this core real estate asset that we own through Prisa. That is a core strategy within Prudential. Right here you can see the front entrance. It's 11 times square. Built in 2010, this is a Class A 40-story office building with retail space on the ground level. The building cost $949 per square foot to build, and after completion, they sold a 45% non-controlling interest at a 32% premium to this cost. Required for buildings in Times Square is, this building has 9,700 square feet of digital billboards on the exterior, which generate almost $2 million per year in additional revenue. The building received a LEED Gold designation at completion due to its state-of-the-art digital building management system, 18 destination dispatch elevators, and infrastructure to support a variety of telecommunication uses. Most of the surrounding buildings are average about 100 years old, so 11 Times Square offers a more modern and secure space for tenants. It has floor-to-ceiling windows, 14-foot unfinished ceilings, and a 6-degree twist in the building so that upper floor tenants have a view looking diagonally between buildings instead of looking straight out at the wall of another building. Major tenants include Microsoft, who leases 19% of the building. There's their sign there. And they're on the lower floors. Microsoft chose to build its own entrance, paying to take the place of planned retail on that side of the building. Proskauer Rose, a global law firm, occupies 37% of the building, taking all of the middle floors, and has exclusive access to all 6 middle-level elevators. Lionsgate Studios has a 25-year lease for 48,000 square feet of retail space. Lionsgate plans to spend $28 million to create an interactive experiential center where customers will have access to rides, simulators, and virtual reality to make them feel as if they're in one of the Lionsgate films or TV shows. For example, one simulator will be based on the movie Hunger Games, and one of the food and beverage areas will be a Mad Men lounge based on the TV show. 11 Times Square.
Payday lending's starting to look good.
What they do?
As Terry mentioned, though, Lionsgate pays for those amenities. They're paying for the lease, but they pay for all that building.
So the fact that Lionsgate is investing $28 million of their own money into this center gives Prisa a lot of confidence that they're going to stick around for the whole 25-year lease. 11 Times Square is on the same block as a subway terminal, and both Penn Station and Grand Central Station are within one subway stop. The New York City tour bus route goes past the building, as well as Broadway theaters and the Wax Museum. A high level of security is something that has drawn these high credit tenants to this building. Security measures include 120 security cameras monitoring activity inside and outside the building, guards on duty 24/7. The director of security and the on-site security supervisor are both retired 20-plus year veterans of the NYPD. And having been built after 9/11, steel pilings for the building are driven much deeper than normal and encased in concrete so that the building can withstand an impact event. So are there any questions about this building? Great, thank you. Well, that concludes our presentation, and I want to thank you very much for your patience with us and for your questions.
So the question is, what are others doing in real estate that we're not doing, and why not? What? Is there major?
You know, grasping at, not grasping at straws, but some people are building much more global clearly have a North American bias. I've shared that with the board time and time again. The North American real estate market is still the largest, most highly adjudicated, deepest, most liquid real estate market in the world. You know, given arguably resource constraints, other risk premia that are not the easiest to assess, we're not gallivanting around the world, you know, looking to spread our risk in China, Beijing, for example. And frankly, I've been hard pressed to find anybody who can demonstrably show me that investing in those parts of the world generate higher returns. Or, you know, comparable, there's a lot more risk over there, frankly, from my perspective. So that's an example.
We're not in the infrastructure space, which you can call real estate. We're not in the infrastructure space for a couple of reasons. We don't have the scale. Those that are 10 times our size, they would build the building directly. We're not doing that, or have the system, or the larger space of infrastructure. I mean, Ethan, any comment about that?
Well, infrastructure is broadly defined, so we're not in the development space that you were highlighting, but we are continuing to look at and consider investments in the broader infrastructure space. You know, stuff like airports, right, or things that support buildings. So we are looking at opportunities in the broader infrastructure space, but we do not expect to do significant kind of ground-up development.
The one other thing I'd add, Carl, is there are other programs that, you know, have if not the entire program, a large portion of it invested directly in real estate, where they have staff that is physically operating and working with their joint venture partners to own this real estate directly outside of a fund structure. You know, they have staff that has direct real estate experience. They're obviously hiring folks who can do that effectively, which we're not doing.
If Jerry stays, would you do it?
Would you be comfortable with that? We could consider that.
Thank you.
Okay.
Thank you. Thank you.
Thank you very much. We are up to the recap, right?
Yes. Looking at our able deputy, we've got guidance from you on a couple of points. I don't know that I would characterize them as to-dos, but we did get guidance on a couple of areas for the portal as far as Jerry's position. I think we'll remember what the guidance is, but as far as something for the next time on the director's tab, as far as getting back to you, I don't hear anything, but
I think I would say it was the
letter
analysis of budget.
Actual,
For the four buildings that are sale potential versus the cost benefit analysis for sale versus continuing to lease these buildings to our affiliates, right, Gary? Right. And I guess the only other thing is, perhaps not on our agenda, this MD&A is sort of a follow-up what we're going to do, right, for the
yeah, we're told that we have to, and so that's a project that we're starting, and we will be reporting back to you at the October. What is the date? The 2nd? Your next board meeting is the 2nd, I believe. I think the audit committee, we will schedule that meeting, and then the letter to Yellowstone County, we'll have our attorney drafted on behalf of our staff, and I'm inclined to have Julie send that letter out. I guess we had more than we thought.
Anything else?
Jerry and I discussed, Jerry's going to have our attorney take a look at the one-year contract from the executive director, so I'm not drafting that. That's not, I don't think that's appropriate.
have the attorneys look at it.
Have our counsel.
Yes, yes.
You got that, Jerry?
I do.
All right. Anything else?
Jerry, okay?
Sorry about the extra half hour, but I think it was necessary. Well,
Sounds good.
we're adjourned.
Nice seeing you guys.